from the fact that there's significant inflows into bond mutual funds. Once the pause happens, I think we all look at what's next. I don't really buy the skip idea because the economy doesn't move, it's not that volatile. I think right now we're seeing the slowdown. As it starts to build up steam, I think it's going to lose momentum really fast. So I don't buy the skip and then re-hike. I think then we'll be all focused on when the rate cuts happen. I mean, we're looking at the 10-year below 3% by year end, at 2.5% by next year. So the 10-year will also have a significant move. I just like the 5-year a little bit more right now because it's more sensitive to economic data.
We've been talking about the resilience in retailers. We've been talking about the resilience in deer sales. We've been talking about the fact that a lot of these companies have been able to pass along price increases, which is one reason why perhaps people are rethinking the view that you just put out there, that it's unlikely for the Fed to cut rates significantly in the next 12 to 24 months. Michael Hartnett over at Bank of America said that the biggest pain trade in the next 12 months is a Fed funds rate rising to 6% instead of 3%. How realistic is that in your mind?
So I can see this. So we're actually looking for one more hike. So we're looking for 5.5. Just listening to Fed speak, I think they would rather pause and stay on hold for longer than actually try and push the last. What's 50 basis points among friends? I mean, they can go from 5.5 to 6. Remember, they're also doing QT. So I think it's a high bar for them to keep going, but I think it's also a very high bar for them to start to cut. Because remember, they're looking for 4.5 on the unemployment rate by year end. I think if we're at 4.5 by year end, we're in a recession. The economy is slowing down pretty drastically, but the Fed might say, yes, this was in our forecast. So I think they stay on hold longer. But I would agree. I think if inflation increases some more, I mean, the Fed's telling us that they want to slow things down. They don't see the slowdown. I think they're going to keep hiking. And as a result, they're going to overdo it. I think we're already in restrictive territory. It just takes a while for different parts of the economy to slow down. I mean, we're not getting that big shock that can slow down everything at the same time, which is why I think it's so tricky to trade this market. We move 10, 20 basis points on not a whole lot of news. I think you just have to be nimble and sort of start to step in. We stepped in yesterday. We're now a little bit long duration here. We get another sell-off here. I think the technicals right now with all the FDIC sales, I think we should think about that as well. It's $100 billion that the FDIC is selling of fixed income paper. That's like new supply that's coming in. I think that's part of the reason why we've risen in rates. But you're supposed to start to think about hedging some of those risk assets. If the economy slows down, I think that's a pretty big pain trade as well.
If the Fed does raise rates one more time, is that enough to break the backs of some of these regional banks that are drawing on some of the emergency lending facilities still to this day, even though the crisis, if it was one, has simmered off?
So the deposit outflows have stabilized, but they're still continuing to leave banks. And I think that's going to continue to happen. It's very hard for banks to compete with deposits when money market funds are giving you, 5%, 5.25%. And if the Fed continues to raise rates, I think that gap continues to be wide. So I think the regional banks are still in trouble, not so much because of massive outflows, but their entire business model, if they're funding from the Fed at 5%, it's very hard to fund your assets, which you bought at 2%. So I think that's going to be a slow drag for the rest of this year and beyond.
Priya, you're outrageous when you talk not only about inversion, but large inversion. You're also very lonely. Can you frame out, given the cards, and let's assume optimistically we're going to get beyond the debt idiocy. Great. Can you frame out a 6% 3-month T-bill, 6% LIBOR, SOFR, other short-term rates? No one's looking for that. All my radar's up.
No, that's true. I think the big pain trade, really, another pain trade is if inflation remains high. I mean, the TIPS market, it's the best indicator of market expectations of inflation. I think it's extremely mispriced. It's sub 2% in the near term. So I think the market's saying somehow magically inflation's going to come down, which is why the Fed will not raise rates. What if inflation becomes extremely sticky? That was the biggest aspect of our inversion call, was inflation is very slow moving, extremely lagging. And so if inflation actually stays high, there's your case for that 6% Fed funds. But does that move the 5-year or the 10-year? In fact, the more the Fed raises rates, the more they'll have to cut. Because I have to think they take rates to, restrictive territory, then they keep it there for a while till things slow down. And that's going to mean that they're going to have to be a lot more accommodative when they start to cut rates.
What's 50 basis points between friends? That's my takeaway from that conversation. What's
It
50
is.
basis points between friends? Priya Mishra of TD. Priya, wonderful to catch
She
up with
could
you.
solve the debt
Always
crisis.
is.
You know, she could
Like
do it
that.
single-handedly.
What's 5 trillion between friends?
Can you imagine being at dinner and being like, splitting the check? What's 50 basis points between friends? 50 basis
nothing.
points,
What's
you pay that.
6% between friends? Deer right now is up more than 6% at the moment. They're saying the right things this morning, lifting their outlook. The CEO, Chairman John May, saying this: Deere continues to benefit from favourable market conditions, Tom, in improving operating environment.
It's just across the board optimism, and of course, it's a huge symbol of manufacturing American might. I really do wonder, I haven't seen it, maybe Lisa, you've seen it, what the dollar conversion is here to lift it up. They've had a little bit of a weak dollar. That's got to play into it. I got that question wrong on CFA level 1, but maybe I'll try to get it right this weekend.
There was a story about how it was many billions of dollars of either headwinds or tailwinds for companies, depending on where they were in the dollar, that was one of the aspects. But even putting that aside, the fact that construction and forestry sales were up about 15%, just to give you a sense of just the scope of how much they've increased some of their of their profitability. But here's the issue: how much is this? Because the price of food is going up. And frankly, a lot of the farmers are wanting to farm a lot more and are replacing their equipment and have the incentive to do so, even at higher rates, because the cost of food is going up.
I'll go with that. I think there's a psychology on that. Ann Dignan at J.P. Morgan over the years has been fabulous on what Caterpillar does and Deere do. And there's always that, to buy the new toy is always out there. But it's just such a symbol, and I would say it plays into global Wall Street as well, because in the CFA curricula, you make or break your CFA level 1 test on Deere accounting and equipment leasing. I mean, and break is the operative word there.
The stock is up nicely in the pre-market. So this is the outlook for Deere. Here's the outlook from Nomura and Jordan Rochester, guys, on China, on the dollar. This story's starting to break, just slowly, just really slowly starting to creep in. That big dollar short consensus call that you've heard so much of over the last few months, things starting to move the other way. Jordan Rochester yesterday publishing this: European and Chinese data surprises are in free fall. It points to weaker growth expectations and with it a stronger dollar in the near term. I saw a lot of that in my inbox yesterday, not just from Jordan, from Alan Ruskin at Deutsche Bank, others too. Kit Duke SocGen talk about the same thing.
Can Aston Villa slow down Liverpool?
That coming up next with Jordan Rochester of Nomura on football and Aston Villa. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. White House negotiators say they are making steady progress toward reaching a debt limit deal. In a call from Japan, where President Biden is attending the Group of Seven Summit, Biden told them he's confident Congress will act in time to avoid a default. House Speaker Kevin McCarthy has said both sides may reach an agreement as soon as this weekend. The G7 nations will agree to work together to track diamonds from Russia. But Bloomberg's learned they will stop short of slapping Moscow with an outright ban. Earlier attempts to sanction Russian gems in Europe have met resistance from importer nations like Belgium. Those countries argue that such moves would just shift the diamond trade elsewhere. President Xi Jinping says China is ready to help Central Asian nations bolster their security and defense capabilities. Xi was wrapping up a summit of the nation's leaders. His decision to assemble 5 former Soviet states without Russia's President Vladimir Putin demonstrated Beijing's senior position in the relationship with Moscow. The UK has laid out its strategy in the battle for dominance in the global semiconductor market. The government's committing $1.2 billion to bolster the British chip industry over the next decade, but that's far less than other countries. The Prime Minister Rishi Sunak says that the UK will focus on where its strengths are, such as in research and design. And the U.S. tractor maker Deere has raised its full-year profit forecast. The company sees rising earnings thanks to strong demand for farm equipment and the easing supply chain problems. Deere is a bellwether for the health of the agricultural industry. It's the world's largest producer of farm machinery. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, This was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges. Next.
It was going to keep rating World Cup. This is a 3.
As the economic picture does.
Is it be okay? Is getting ready to make a decision.
History shows that monetary policy works with long and variable lags, and that a year is not a long enough period for demand to feel the full effects of higher interest rates.
That's Philip Jefferson, the Fed governor and presumed future Fed vice chair as well. I have to tell you, that didn't really make the headlines yesterday. This did, from President Logan of the Dallas Fed, who said this: the data in the coming weeks could yet show that it is appropriate to skip a meeting. As of today, though, we aren't there yet. That's the call from President Logan going into the mid-June meeting and maybe leaving the door wide open for another rate hike by this Federal Reserve. And we'll find out if Chairman Powell is willing to walk right the way through it a little bit later this morning when he speaks at 11 a.m. Eastern time. I'm just distracted by a bit of news coming from Axios, and I think this really meets the tone that we were kind of given a little bit earlier in the program. Axios saying that Treasury Secretary Janet Yellen has warned the country's biggest bankers that a potential debt ceiling default will have repercussions beyond the financial system, and insisted, here's the important piece, that the early June ex-date is real. Now, this is something we keep going back to.
Yeah.
When Treasury Secretary Janet Yellen came out and said early June, maybe as early as June 1st, there's always a feeling that as a policymaker, the prudent thing to do is be conservative and have a 1-month cushion, maybe even longer than that. There's just a feeling based on the cash balance of the Treasury over the last week, Tom, that perhaps that early June date is more real than we thought it was maybe a few weeks ago.
The only way to understand this is to go into Treasury next to the White House, and you stand there, and I've done this with radio shows over the years, in the cash room. And there's an ornate 19th century, John, I'm sure there's an equivalency in London, of where cash actually moved for the United States of America. And we're all, including our vaunted politicians on both sides, removed from the cashiness of society. The Secretary of Treasury, whoever the president is, doesn't have that luxury.
This is getting real, Lisa. Just slowly. Just slowly.
Well, perhaps this is the reason why we're hearing real talk out of the likes of Kevin McCarthy and President Biden saying there actually is something that needs to get done next week. And that's what Anne Marie was talking about. Yeah. It needs to get done. Perhaps that's the drop dead date because this is a real deadline.
That's the deadline for the dead talks, and we're going to hear more on that through the next hour or so. This is what we're hearing a lot of from the South side at the moment. Just maybe this view on Europe, China, the rest of the world is starting to break. Jordan Rochester of Nomura wrote this: European and Chinese data surprises are in free fall. ZEWs, IP, factory orders, retail sales have really pushed the Eurozone data surprises to big lows. It points to weaker growth expectations and with it, a stronger dollar in the near term. Taking a look at a euro dollar over the past 10 days or so, this is what we look like. A break of 108. 107.93. This is a big change, Tom, from the 110 pushing 111 from a few weeks ago.
Joining us now, Jordan Rochester of Nomura. Jordan, we could do a 1 hour conversation here. We don't have time for that. I'm going to go at rapid speed. John and Lisa are going to jump in as well. What is the significance of renminbi out past 7? Once again, we visit through 7. It's been ages since it's 7 yuan per dollar. What is the symbolism of 7.01 yuan CNY?
Well, for market psychology, it's a big deal. But for us, we think that actually maybe the sort of 725 to 730 level is where the PBOC will be more uncomfortable. We have had a statement, of course, today saying that they want to reduce speculation in the currency market. We've seen that sort of statement before, but that's kind of why we've seen CNH rally a little bit today. But for us, the momentum in the Chinese economy has changed quite significantly from what we hoped it would be, what the market hoped it would be just a few weeks ago. And that has been really driving the renminbi underperformance. But it's also the US side of things as well. We've had more hawkish statements from some of the regional Fed governors. John actually flagged a few of them from Logan yesterday, for example, and Mester. And that's helped the Fed pricing adjust as well. So we have less rate cuts priced for the Fed this year too. Combine that together, we're looking for 730 in dollar CNH by middle of July. That's quite a quick move in the grand scheme of things. We've been kind of in a low volatility environment. A lot of people had actually got quite bored at putting on sort of CNH risk, and we're looking at other proxies for it in the G10 or in EM. It wasn't really the scenario for us. We think that actually it's going to have a big move to come.
Jordan, a lot of people now starting to think about maybe going the other way in the FX market, leaning into some dollar strength after that big consensus view built up over the last few months off the back of what's happened with the data, just subtle shifts that you've identified. Jordan, can you identify the best way to play that through G10 at the moment?
Yeah, absolutely, John. And the one thing this market keeps reminding us is you can't lean back. You can't say, I've got this long-term medium view of euro upside, which we do, and relax. You can't just crack out the popcorn, get the nachos, and watch the film. You have to be active and respond to events. And what's happened here is the data in Europe has really underwhelmed. I thought at first we could ignore it, John. I thought the factory orders falling lower, that's something that maybe could be corrected in the next month. But what we've actually started to see is the more forward-looking signals, such as the ZEWs, those sort of Centix index in Europe, they've also been turning lower as well. So the momentum's gone. We're not short Eurodollar. For us, we think the better trade is short cable. So why is that? It's because, first of all, next week we've got UK CPI, and we think there's going to be a big drop in that number. We could actually go below 8%. We've been above 10% for roughly around 7 months or so in the UK. It's been quite painful for the consumer, 10% double-digit inflation. Hopefully next week we get that sign that the Bank of England has done enough, and we get that below 8%, 7.9% our team's looking for. If we get that, John, the pricing for the Bank of England, which is around about 45 basis points for the next 2 meetings or so, that might head lower. We think there's just one more rate hike to come. So it should be more towards 25 basis points to 30 basis points.
Jordan, I love how you describe people getting bored as they put on one trade for too long and then just switch it over to something else. It sounds like basically a junior high school version of macro trading. I'm just wondering from your perspective whether this is basically going to be the most painful chop, swipe down, John, the most painful chop that you can possibly imagine, just because it is so tough to stick with any one trade for a considerable period of time.
I think it's quite like 2021, which was a really difficult year for us. I remember it quite well. 2020, we had the vaccines invented, the euro rallied, we got to 123, dollar weakness. Then we got to the beginning of January, and Joe Biden's Democrats, they won those Senate seats in Georgia, and we had a 3% swing higher in the dollar. It caught us off guard. It caught a lot of people off guard. The market was pretty much overly positioned for dollar weakness at the time. I think that's kind of where we got to. Most client meetings, not recently, but about 2 weeks ago, it was, we agree. We think euro goes higher. We think the pound goes higher. We think the yen goes higher. That's now changed quite substantially with these data surprises and market moves. And I think it's a lot more uncertain out there. It's going to be a bit more like 2021, I think, where for 9 months of that year, we had a zigzag in the dollar. So the dollar went up for the first 3 months, then it went down for the next 3 months, then it went up again in the 3 months after that. It was only in Q4 2021 when we got a pure sense that the gas supplies that Vladimir Putin was essentially restricting before he invaded Ukraine really added to that dollar's strength. And also we had the inflation spike in the US at the time as well. So we're kind of in that sort of mean reversion place in the G10FX, and that's the tricky part for this year so far.
Jordan, is that why you're only willing to make a short-term tactical call right now with regards to this strong dollar?
John, to be tactical is important. You have to make money here and now. So yes, we always have our eye on the next 1 month horizon. And then after that, we think about the long term. The long term is, I think euro does head higher again, John. The terms of trade are fantastically moving in euro's favor. It suggests euro should be 115 to 120. So medium term, I haven't turned massively bearish on the euro. But in the very short term, I look at those Fed cuts that are priced in, John, roughly around 45 basis points now, let's say. I think that should be more towards 25, and then perhaps the market might start to fade that.
You know, my question, John, is if you're with Aston Villa and you're sitting in the Kop at Liverpool, I mean, medium term really doesn't matter.
I'd suggest that if you were an Aston Villa fan, that you don't sit in the Kop end. Jordan, you're not doing that, are you?
Maybe not. I can't
Maybe
confirm.
he is. You think in a Villa shirt?
I'm not sure what colour tie I'll be wearing.
I think they'll be kicking him back out.
This is fun. I mean, Aston Villa wasn't supposed to be fun this year, and it is. Like,
no, they're playing really well.
It's fun.
Jordan, you must be happy.
It's fantastic. I mean, we were fighting relegation not long ago, so this is just to be in the top end of the table and actually look at 5, 6, 7, 8 and think maybe we've got a chance of being there is fantastic.
I've got to talk to Tom about Championship playoff finals in the next week or so, Jordan. So wish me luck. Jordan Rochester of Nomura. Got to explain to you who Coventry City are, Tom, the Sky Blues.
I noticed that the Sky Blues are doing well. They're doing better than Queen Park's Rangers.
There you go.
I noticed.
QPR.
Did I do okay on
Mohammed's
QPR?
team. Nice.
Did
that was
I do
perfect.
That okay? Lisa helped me with that.
Coventry City looking at a promotion, TK.
Folks, full disclosure
big
here.
news,
I'm like
big
clueless on this, okay? I'm just doing this because Pharaoh makes me do it. We have tantrums. We have a domestic.
A domestic?
Yeah, if I don't keep up
Young
with
Pharaoh was
football.
once on trial at Coventry City as a lad. That didn't work out,
exciting.
which is why I'm here.
Now, seriously, if they win the league that they're in, does Coventry City go up?
So this is the
League?
playoffs. They're in the playoffs. Someone else won the league. This is the playoffs, the final spot to get promotion to the Premier League. Big money.
They could be in the Premier League. That's
could be.
really
They
cool.
could be back in the Premier League.
It's so much better than
Very
America.
cool. And then I'll take you to Cov, Tom. And we'll
Kansas
watch
City Royals are
football
going to
over
get.
there. That'd be great.
Kansas City Royals are going to get relegated.
Who would come up?
Rochester Red Wings.
Nice. Is that a real team?
Luke Easter, Boom Powell.
I've got no idea. Your equity market positive now, 0.1% on the S&P 500. Linda Dussel of Hermes on equities joining us next.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion
per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
We should see some progress on inflation in the coming months.
If you think the U.S. has an inflation problem, Europe has a much bigger one.
Real purchasing power has declined over the course of the last 24 months.
There's going to be a realization here that the economy is not collapsing.
The markets haven't done anything. So no one is right, no one is wrong.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
9 months highs in the equity market. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market just about positive on the S&P after closing yesterday at the highest since August 25th, the day before Chairman Powell warned of pain in Jackson Hole, Wyoming. Tom, on August 26th.
Well, that's where we've been. And it's in a collar, and we're up at the top of the collar looking at SPX. The VIX yesterday got down to 16.02. And the answer is, can you say breakout? Absolutely not. Technically, there's no way you could say we reached beyond to some new territory. But nevertheless, on a Friday, the bears are looking at the ceiling going, okay, what do I write about for Monday morning?
Missed it.
No, I'm not going to be that harsh. Carl Icahn, I thought was great. He came out, he said it's cost him $9 billion, but he's playing a different game. The strategists on Wall Street, you can remain intact neutral, intact bear, because we really haven't broken out with enthusiasm.
Adam Johnson. Remember Adam? He used to sit on this table.
Yeah,
Adam's
great.
fantastic.
Yeah.
Adam on the equity market over at Bullseye. He said, if you see a bear, hug them. They need it. That's what he said, which sounds brutal. But if you really think about the range of the year so far, 3,800 at the low end, 4,200 at the high end. We had a sneak peek above 4,200 yesterday, Lisa. 4,198 at the close.
I'm going to defend the bears a little bit because that's my role. I will just say this is the year the index trading.
Breathe the gloom.
The index trading trade has died, and I will say that when we talk about the index being range bound, I do think that that really goes against what some of the trades have been under the surface, which have been relatively violent. You talk about Nvidia and a 100% gain. Take a look at Microsoft. Take a look at Google. Take a look at Amazon. All of these trades that are actually getting a lot of steam based on AI, based on tech, based on capital expenditures. So at a certain point, is this really a market going nowhere or just a market that's splintering under the surface?
Beautifully framed, and what's not being spoken about is not Nvidia or even what Apple's doing. 191, I think, is a $3 trillion company. It's that the gloom of the SPX bear market has made it halfway back. I mean, nobody's talking about, you know what, it was pretty ugly, pandemic and all that, and we've made it halfway back. Even the bears, I don't think they even want to give credit to that move.
We've spent a lot of time talking about, and months talking about this, revisiting the lows of October. Spent a lot of time, and then the grind just continues. Now, you get to this kind of point, and I always find markets really, really interesting from the psychological aspect of it. And this is what Michael Hartner's talking about this morning with this quote here. It would be so on brand for stocks to mount up into recession. You suck them all in right before the hard landing. That's quite a powerful quote, because I think that resonates with a lot of people listening to this right now, Lisa. They weren't in those names that you've talked about. They haven't been riding high in the equity market off the lows of October. They're sitting here and they're wondering, should I get in?
Well, but even Eric Friedman earlier in the show, he was talking about how he's generally pretty pessimistic. Can you get short big tech? Kind of tough. Take a look at capital expenditure. It's still happening. So even the people who are seeing some clouds at the horizon aren't sure that this is still the interest rate sensitive kind of bet that's as vulnerable as it has been in the past.
We're going to talk, John, to a wonderful guest on fundamental analysis, but I thought a real moment yesterday was Jim Bianco, CMT, very good at technical analysis, disagreeing with one of his and mine heroes, Ralph Ancampora. Ancampora saying October, bear market low. Bianco's not there, and that's a debate into the weekend technically.
Tony Dwyer summed it up brilliantly this week, didn't he?
Yes, that was a great note.
Too anxious to get short, too nervous to get long, and kind of stuck somewhere in between right now, Tom.
He has like 4 kids in New Hampshire in summer camp.
That's going to cost you.
He's a freaking saint.
It's going to make you anxious.
He's just, his note was on fire yesterday. He has to write those notes to pay for summer camp.
Very cool. Let's get to the price action. Equities look like this, just about positive by 0.2% on the S&P. In the bond market, Lisa, yields just turning higher just a moment ago, 365 on a 10-year.
And people pricing out some of those rate cuts that they had priced in earlier this year. Today, we do have those G7 talks taking place. Very curious to hear what they have to say about China. We are going to also be hearing about what President Biden's update that he gets from Washington, D.C. on the debt ceiling will be later today. 8:30 a.m., Morgan Stanley's annual general meeting. Interesting to see whether there are any comments about what to expect out of lending standards, regional banks, what the read-through is to their business. And today, Fed Speak includes New York Fed President John Williams at 8:45 a.m., Fed Governor Michelle Bowman at 9 a.m., and the main event, 11 a.m., Fed Chair Jay Powell and the former Fed Chair Ben Bernanke in this conversation. Does he endorse what we've been hearing and the splintering views? Where does he weigh in terms of where the balance of risks lies?
Tough call, isn't it? Because you're going into a June meeting, you've got no idea what the debt ceiling scenario looks like. Latest reporting coming out of Japan, Anne-Marie leading the effort here at Bloomberg, is that the president will leave a G7 dinner early. According to the press secretary, the plan is for him to get an update from his negotiating team. The latest from Axios suggesting that early June date, Janet Yellen, the Treasury Secretary, is pushing the story, Tom, that is very real.
This is different than how President Trump would handle it, but with great respect for all, this president has miles of legislative experience. And it's a symbolism, John. I don't know what he's going to do after the dinner. Maybe he's going to watch,
watch the
highlights
golf.
or
Sure.
watch some golf, watch the PGA Championship. But it's the symbolism that he's leaving a G7 dinner to get briefed on what's going. It's the theater of it as well.
They clearly want us to understand that.
Yeah,
clearly.
Yeah.
They want us to be talking.
They want the Republicans to understand that.
He might be abroad, but he's going to leave a dinner early and prioritize domestic issues. There's always a spin there when you get these kind of stories. Always.
Let's remember, he was 2 years old when Hiroshima happened. I mean, this is the last of our World War II presidents, and the theater is part of it.
I believe we'll catch up with AMH a little bit later this hour. Looking forward to doing so. Joining us now is Linda Dussel, the Senior Vice President and Senior Equity Strategist at Federated Hermes. Linda, let's start with this one. Easy question. Are you too nervous to get long or too anxious to get short?
Good morning to you. We at Federated Hermes have been sticking with the wide range that you just referenced, 3,800 to 4,200, and we're there right now. So we think that, on the high end you trim, and on the low end you find bargains to buy. And what are the bargains these days?
Well, what are the bargains, Linda? I mean, I'm sorry, you caught me there mid-awares. I thought you were going to give me 3 names so I can get through the weekend. What does John Deere is an iconic Federated holding? What does John Deere symbolize with that buildup of free cash flow and the ability to adapt to very good numbers?
Yeah, well, the recession that everybody's been waiting for hasn't come. And of course, this big name that would reference that. Where are the bargains now? Are in the small cap stocks. And you were talking just before I came on about how strong the stock market is. Truly, it is, as we all know, it is a very, very narrow advance in the stock market. If you look in the United States, in the last 7 weeks, we've been trading in an extremely tight range, not even a 2% range in the last 6 weeks. Now, the pain trade is obviously up, and we're all looking at this, and we're all saying, I know it's 4,200. I know that's the high end of the range. It's been driven by a handful of stocks. The breadth has been extremely weak, the weakest it's been in 45 years. What does that mean I'm supposed to do? History says it is not clear. Nothing is particularly clear, and just for the first time today, I'm reading the word malaise. We said that word a lot back in the 70s and the early 1980s. What do? You clip coupons, and if you have a really long-term view, small caps have been absolutely crushed.
Do you think, Linda, that there is a trade in big tech that you can either get long or get short, or do you avoid because it's been so volatile and it's been, frankly, the focus of this narrow breadth?
Yes, it is, but the tech trade has been in the largest cap techs. The equal weighted is still not, particularly overbought. Technology is fantastic, but also, as we know, these biggest names are driven by the excitement for AI. It's kind of more on the come, so that's kind of already in the stocks. But I saw very interesting statistics, and it's been a few months now, quite a few months probably now, that says this breadth that we talk about that's so very, very narrow. Well, guess what? These huge companies have the cash flow that deserves the percentage of the market cap that what they are in the S&P 500. They are strong and extremely strong versus the rest of the market, but the rest of the market has gone nowhere. So you can look for it. It's just an ideal stock picking environment. You can find other ideas beyond the top 7 names, which have just moved the entire market this year to date.
This has been a market. This has been a market that's been trained by years of financial repression and the macro trade, not necessarily individual stock picking. So, at your point, do you feel like people will all flood in at the wrong point rather than just going toward the stock picking trade and say, maybe we were wrong, maybe the index can get to 4,600 by year end?
Well, it definitely can do. We're saying that it can do that. But, in terms of what people are doing and what are they holding back? And I mean, one of the question that I get asked most often as I travel is, what can I buy? There's so much dry powder. People are so tired of waiting. Please give me my recession, please, I think is what Steve Auth has, my boss, Steve Auth has been putting out there. Please, can I please have a recession now? No, you can't have a recession yet. And what people are not talking about, in my opinion, enough, is that there's still $1 trillion of excess monies out there in our consumer hands looking to be spent. That's why we need to be patient, whether we're bullish or bearish. We need to spend that money down, and that will include buying, just small dips in the stock market. You really have to do your homework.
Send our best to Steve, won't you, Linda? Big fan of Steve, or send our best to Steve. Linda Dussel there at Federated Hermes. And we're sending our best to you, Linda. Thank you. What do you make of AI and all this chat that AI might be in a bubble already, Bramo? 5 months into the rally.
I want to understand where people are actually using it. I don't buy that it's going to be something that totally disintermediates everyone's jobs, but which are the companies that can strip out the greatest number of workers or bolster how much people can be productive in their positions? I want to understand more of that and less of AI is going to cure the world. Yay, jump, and I think that there's a little bit of that gets me a little concerned.
Or end the world.
Well, then there's also the Armageddon, it's going to take over.
Armageddon's an easy trade, If you believe, and it is. Armageddon's the easiest trade in the world.
You're talking to me.
Max Long. Nothing to lose.
100%.
You're going with it. So if you believe AI is going to go to the end of the world, guess what? Max Long. Armageddon's like the easiest trade out there. Sometimes it's so bad, it's so good.
Stuffing cereal in your mouth the whole way down.
There's only upside, right? The world's going to end.
I guess so.
Maybe it won't.
Yeah.
Great. Max Long.
100%.
The toxic brew trade.
Yeah.
No.
I want to come back. When we come back, John, I want to talk about something Linda Dussel said there. She was on fire.
Very cool. We'll do that
really
in a moment.
Good.
David
really
Baden in the next hour. Look out for that from Citi on stocks. Equities right now in the stock market, just about positive on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden is urging his negotiators to keep pursuing a debt limit deal. In a call from Japan, where he's attending the G7 summit, the president said he's confident that Congress will act in time and avoid a default. House Speaker Kevin McCarthy has indicated both sides may reach an agreement as soon as this weekend. Ukraine's President Volodymyr Zelensky will travel to Japan to join G7 leaders in person. Officials have added an extra session to the summit's schedule on Sunday to accommodate his schedule. Over this past week, Zelensky visited European capitals asking for more weapons. Republican Senator Tim Scott reportedly will begin airing TV ads in Iowa and New Hampshire next week. According to the Associated Press, Scott also plans an announcement on his potential run for president Monday in his hometown of North Charleston, South Carolina. Last month, Scott formed an exploratory committee, allowing him to raise money while weighing a White House bid. Shares of Foot Locker are plunging. The sports shoe retailer cut its full-year sales outlook and reported first-quarter sales fell more than 9%. Foot Locker also said that merchandise inventories were 25% higher than at the end of the first quarter last year. And the U.S. tractor maker Deere has raised its full-year profit forecast. The company sees rising earnings thanks to strong demand for farm equipment and the easing supply chain problems. Deere is a bellwether for the health of the agricultural industry. It's the world's largest producer of farm machinery. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
There's two types of people when you talk about the debt debate. There's those, to put it in Bloomberg terms, that Anne-Marie Horton would interview that would tell you there's a 40 or 50% chance that we're going to default. And then there's the Wall Street types that'll tell you that there's a 3 or 4% chance that we're going to default. And I'm probably in the 3 or 4% chance that we're actually going to see a default. We're going to see a lot of political theater.
Tons of political theatre. Jim Bianco there, the president of Bianco Research, on the latest debt ceiling negotiations. I can't give you the odds. I'll just give you the latest reporting from Anne-Marie, who we'll speak to in just a moment, that the president will leave a G7 dinner early, according to the press secretary. The plan is for him to get an update from his negotiating team. There is a feeling that maybe we might have a framework for an agreement, perhaps as soon as late this weekend, Tom. I can only also offer you the numbers. We did that last hour. It's worth doing it again if you are just tuning in. Welcome to the program. This is the Treasury cash balance. It's dropped to $68.3 billion as of May 17th. This can be a really volatile number day to day. So if you do it week on week, that $68 billion number down from 140 last week.
I totally agree with you. That is a zeitgeist into the weekend. To me, that's a key number, and that's going to be at the staff level. They're going to go, do you guys realize what the vector is on this? What do they do when they break 50 billion? I don't know.
And they've got to come to an agreement, Tom, not just the staff level. They've got to then do that at the higher level, and then they've got to get it through Congress. There's still a lot of work in the process to be done here.
There is, and the work's going to happen over this weekend. I think this is going to, I'm more optimistic about this. I think the discussion and the come to Jesus moment, if you will, is going to happen a lot sooner rather than later. I go this weekend. Distracted by all this, in Japan, Anne-Marie Horton joins us, our Bloomberg Washington correspondent with President Biden at the G7 meetings. Anne-Marie, I want to get one Pacific question in before we get back to the specifics of the debt battle. And that is, Joe Biden was 2 years old, as Peter Baker told us this morning, when this bombing happened in Japan. It was an exhausted America, an exhausted force coming up from Australia, where MacArthur was. We will not visit Australia. Going through with immense heroism, 200,000 allies dying in Papua New Guinea. He's not going to visit there as well. But there's a new America in the Pacific. What is it? What is our American exceptionalism right now as we reacquaint ourselves with the Pacific?
Well, this is what's so difficult about this trip, right? And this got to the heart of my conversation with Admiral John Kirby yesterday, who he said the president can reschedule a trip to Australia. The president can reschedule a trip to Papua New Guinea. He cannot reschedule a potential default. And that is something that is a concern for all of these world leaders, G7 or not. But what he has said to me as well is that what they've seen is extensive months and years of work with the United States really putting a bigger emphasis on their work in the Pacific Rim. And that's what you actually see here on the G7. Yes, of course, the debt ceiling is looming large on the president. It is changing his plans. Many critics are saying the dysfunction in Washington is undermining this administration's foreign policy goals. But the administration says that's just really too easy of a narrative and just not true. The president is still going to have those important conversations, including the Quad, on the sidelines here of the G7.
And John, this goes to John Kirby's interview with Anne-Marie Horton yesterday, where the Admiral Kirby was clearly frustrated at how the debt debate, which is tangible, has taken over this meeting.
His language, he didn't want the U.S. to become a so-called deadbeat nation and not pay its bills. Pretty emphatic stuff. AMH, I'm just looking at this Axios reporting that Treasury Secretary Janet Yellen has been telling people publicly, privately, that this early June X date is real. AMH, do you get the sense that it is real based on your reporting at the moment? Because initially when we got that date, there was a feeling there was about a 1 month cushion, maybe even longer than that. How real is that X date?
Well, when we first got that, she said as early as June 1st. But I even got the sense from her when I sat down with her in Nagata that there is an immense amount of concern within Treasury. They want to see Congress act. She didn't even want to discuss the potential contingency plans if there were to be a default on which payments the United States could prioritize. So this is something that is not just looming large on the president here at the G7, clearly looming large on her and the Treasury, because she has not changed that posture. It is as early as June 1st. And what you hear in terms of the political rhetoric right now is that they are rushing to get this deal done by the end of May. So I think that speaks volume to the concern that really as early as June 1st is pretty serious. That first week could potentially be when the U.S. could suffer a default if they do not have a deal and if they do not lift the debt ceiling.
Does this backdrop, Anne-Marie, weaken President Biden's negotiating power at the G7 when it comes to things like supply chain resiliency and coming together on some sort of China plan?
Well, I think the president wanted to come here with a big message to his partners that he wants to make sure everyone is aligned when it comes to dealing with China. What you constantly hear now from officials within, especially the European Union, within the United States, is they don't want to decouple, they want to de-risk. This seems to be the language all leaders are coalescing around, but it was an important message the president had to bring, especially on the heels of Emmanuel Macron's trip to China, the interview he gave back, talking about strategic autonomy. The United States wants to see the G7 speaking with one voice when it comes to China. But now the president is coming here and he has to answer questions about concerns from all of these world leaders on whether or not the United States is going to default, because they know as much as the White House knows the damage that would do to the global economy. So in that respect, it does create a little bit of a wrinkle, to say the least, for the president, is having these negotiations, shoring up all of his allies to combat China and have tougher language on China, especially when it comes to economic coercion. But at the same time, also making sure to say to them to assuage their concerns that the U.S. will not become the latest risk and issue for the global financial system.
AMH, great to catch up with you. Appreciate it, as always. Anne-Marie on the latest at a G7 over in Japan. Just tremendous reporting from her, as always. Just want to bring you the latest in the market. We had some numbers from Deere a little bit early this morning. They've raised their outlook. That stock is higher. Was as much as 6%. Now it's about 3.6%. That's the latest from them. I have to say, Lisa, I know you're probably going to look at this in a few moments, but worth bringing up now. Foot Locker not exactly doing the same thing this morning, and that's hurting others.
Well, and this is sort of the issue of the zombie roll-up that Tom talks about. How many of the companies that have really struggled with their footprints, with their brands, are continuing to struggle while others gain? Are you seeing basically the winners take all at a time when the losers really lose market share? Foot Locker has really struggled, so let's just be honest. So this is coming after already weakening. I mean, have you ever gone into Foot Locker, ever?
Not for a long time.
Right.
Not for a long time. Used to, but now direct-to-consumer from the likes of Nike is so good.
Yeah.
Why would you go to Foot Locker when I can just go straight to Nike and get it delivered?
Should I get the Air Jordan high cuts or low cuts? What do you think?
I don't know which ones are going to work for you, Tom.
I don't, you know.
What would you prefer?
Email in, folks. This is a raging debate at home.
I'm more of a low-cut kind of guy. I've never really been.
But they're not. They're fake. They're like
high
low
high tops are cooler though, right now.
What did Michael wear?
I'm not cool anymore, Bremo.
Well, I can see you in a
imagine
low
me
top.
walking around with high tops?
No, it wouldn't
Come
work.
on.
No, because you
That
want the
doesn't work.
subtle. You want the, what's it called? Quiet.
Stealth wealth.
Stealth wealth, yeah,
Stealth
thank
wealth.
you.
Not for me. That's just a suggestion for others. Stealth wealth is a good thing. No brands. No brands.
Not for you.
Yeah.
You're not into stealth wealth.
No, these are just recommendations.
For the general public?
For the general public.
That's a PSA.
Can I ask you a question seriously about this whole fashion thing? And Bloomberg Intelligence, Andrea Felstad and others have really been good on this, on the luxury thing. Do posh people do stealth wealth in the United Kingdom?
Oh, you mean like proper posh people?
Proper posh people.
Like the
Do
upper
they do
class?
stealthy?
No, they do hand-me-downs.
They do hand-me-downs.
So it's like your wax jacket from your great-great-grandfather. They don't buy clothes.
Oh, okay.
No.
I'm learning every day.
You know, I went to school with people, most of whom had no money, and when I was growing up, and everyone dressed up real nice, and the people with money didn't. And one of my friends, I once asked about this divergence, and he said, I can't afford to dress like that because of the way that I'll be treated.
The posh kids also, they have really bad fashion sense. Do you know why? Because they go to those schools, they're told what to wear, and then they have their church uniform for a Sunday, and it's a uniform, it's life. They have a uniform for everything they go to, and that's it, and it's just a bunch of hand-me-downs. That's what the posh people do, which is why they're all sort of like uptight in that tweed in winter.
And they don't go to Foot Locker, which is really where we began.
They certainly don't go to Foot Locker.
There you go.
They don't know what Foot Locker is. From New York, this is Bloomberg.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
All of a sudden this week, this market got a little bit more interesting. It was getting boring, really boring. Now we're at the very high end of the trading range for the year. 9-month highs on the S&P 500, back to the levels we last saw when Chairman Powell was in Jackson Hole, Wyoming, talking up pain on the S&P 500. That morning, we opened 41.98 on the S&P. Yesterday, we closed at 41.98. Jens Nordvig of Exante Data, good friend of this program, just wrote in, sometimes the stability is blurred by the vol. It's been a bumpy road to nowhere, let me tell you that. The lows of late last year, talking about threatening to go back to those lows, and then this slow grind higher at the index level. And beyond the index level, Lisa's talked a lot about this. Beneath it, some big moves we can discuss in a moment. In the bond market, 2-year, 10-year, 30-year, Monday, Tuesday, Wednesday, Thursday, 2-year higher, Friday, and some more. Up almost another basis point on a 2-year, 426 on a 2-year yield after starting the week, Tom, with a 3 handle south of 4%.
Moments ago, as you write your bear market note, I'm cautious for the weekend. You're looking forward, John, and the answer is you're doing it within a VIX of 15.99. We have just moments ago fallen below 16 on the VIX. This is a 15 handle is the language, 15.99. I know it's not that much different from 16, but yes, it's really different. A 15 on the VIX, down from 20 sweat, 30 real sweat, 40 massive angst. We're miles from the toxic brew of a VIX of 27.
Just eating away at the consensus views out there at the moment. In foreign exchange as well. Let's finish on the euro. So we come into this year, it's basically this story that things are going to dip, then they're going to rip. Dip in the first half, rip in the second half, and you want to be overweight Europe in a big way. Well, if you were overweight the luxury players, it's delivered in a big way. The euro threatened 111 just a couple of weeks ago. It's back down to 107, just about 108 right now. A break of 108 in the last 24 hours. And the data started to shift, started to crack in the other direction. And Lisa, I got note after note yesterday. Just opened the inbox in the gym. Deutsche Bank, Alan Ruskin, Jordan Rochester, Nomura. The morning started with SocGen's Kit Jukes talking up, just eating away at those rate cut calls for the second half, encouraged by President Logan of the Dallas Fed, eating away at some of those dollar shorts as well.
So at what point can you basically go long the dollar or just gird for the chop that could potentially chop your head off if you're on the wrong side of a choppy day? I am really interested in the specific names because those stories are perhaps clearer than the overarching macro story. Foot Locker, we were just talking about, we're not going to get into stealth wealth again. But basically, this concept of revenue declining as much as 8% this year, even with inflation, just to put that out there, previously said the drop might be about 5.5%. Those shares severely lower. I'm sure we'll be talking about existential risk in not so short a time, 25% decline. Deere, we've been talking about this incredible beat. Their net income for the quarter rose to $2.86 billion from $2.10 billion. Just to give you a sense of how significant this has been, 30% growth in sales. Is this just simply the farm trade? Disney shares I have on here, not because this move is interesting, but because there have been a number of stories that really were interesting overnight. The political story was Walmart canceling 2 significant investments in Florida, one for their campus,
right, yeah.
and the other, they have this Star Wars themed hotel that
Disney
they're closing.
did this, yeah.
But the other one, ESPN, spinning off into its own entity that you have to pay for separately. Very interesting at a time when so many people have been talking about them selling it in a more significant way.
That last point is Wall Street Journal reporting. You and I were talking about this a little bit early this morning. Tom, I'd love to know how they're going to price that. Because the model at the moment basically involves people who pay for cable, who don't watch ESPN, but ESPN ends up getting the money. How are they going to price that?
So MSG's new streaming service, which offers New York Knicks and Buffalo Sabres games, is priced at $30 a month. That's according to the Wall Street Journal reporting.
I saw that number and I was like, you got to be kidding me. No one at my house watches TV. I get it for sports, and I guess I'm paying the ginormous amount I'm paying to watch 10 minutes of the Tots, a little bit of Mets baseball, which is on regular TV now, and all the rest I'm watching off MLB. You know, everybody's got their own anecdote, their own story, but the answer is I don't know where big numbers like $30 come from when I'm getting Mandalorian for $6, or maybe I'm getting it free. I don't even
You'd
know.
have to imagine that's the end of the cable bundle if they do come out of that.
Oh, it's huge.
That would be the end of it, right?
The death knell, 100%.
And I don't have the exact numbers here, but in particular for our international audience, if you pay $60, $70 a month, ESPN gets $9. Everybody else gets like $2.
I'm not even sure what the cable bundle even means anymore. I technically have a bundle, it's called Hulu, and it has everything on it, right? It just streams. I don't have that silly box anymore. And if I have Hulu, I'd imagine surely ESPN's going to be a feature on Hulu still.
You don't want
given
the
that Disney's...
You cut the cord simply because you don't like cords.
Precisely.
And you don't like
We've talked about this
boxes.
before. We've talked about this. I was
physical,
not
it's
the
the
only one who
aesthetics.
did that.
Really?
It's just so much easier just to have a TV connected to broadband, and then you have a streaming package like Hulu that has everything on it, YouTube, take your pick, whatever it might be, than have someone come around and fit a box and have cables all around the house. Who wants that?
So buy it here, $39.99.
You know, whatever. I mean, I'm not here to sell cable. I'm not here to sell cable, that's for sure. TKU. I actually find the interesting story around Disney, the former,
I would agree.
And Florida. Governor DeSantis is a very interesting guy. He wrote an op-ed in the Wall Street Journal, I think a couple of months ago, which I encourage everyone to read. I wonder if he's just too smart for his own good sometimes. And when you start to embrace the go woke, go broke thing, are you leaving behind this idea that the Republican Party stands for being the party of business? Because there's a little bit of tension here at the moment that's emerging.
A little. I mean,
it's not good.
Yeah.
It's not good.
Which is the reason why this $900 million investment that is not going to be made in Florida could potentially be Disney's revenge. And this is going to be a really interesting moment for the governor of Florida.
You just wonder how this is going to play now. The governor hasn't announced his run yet. There's some speculation that might happen after Memorial Day weekend later this month, Tom. And I don't really buy into the polls. The polls are too early for me. It's still too early for me, Tom. I think when you get polled, you just go and say, I'm going to vote for the person I know most, and that's going to be the former president. So let's see what happens after he announces. Then there's a few months to go around the country and gets more broadcast interviews. And
there's
all
miles and miles.
It's ages away. Ages away.
I don't have that.
But I'm interested in what the strategy will be. Are you just going to talk about woke, liberal policies this, liberal policies that, or are you going to stand for something a little bit more than that? And let's see how it develops.
Well, we're going to have to see, and we've got a team that's going to go through that, and part of it is folding in the culture wars into what we do here on economics, finance, investment. You've got to read here into George Bory.
The culture wars at the Federal Reserve right now. This is George Bory of Allspring weighing in on the Fed's path forward and saying this: with the Fed much closer to the end of rate tightening than to its beginning, fixed income investors should start to position for the eventual normalization of the yield curve. This includes extending duration and positioning, Tom, for a steeper curve.
George Bory writes brilliant, sharp, short notes, and does this so much so with Allspring because he's visiting their clients nonstop. The chief investment strategist for Allspring joins us this morning on fixed income. George, in the equity markets, we comfortably say to strategists, what are you hearing from your clients? We rarely say that in the bond market. In all the meetings you're having at Allspring, $400 gazillion of assets, what do investors in bonds feel now? What do they want to do?
Yeah. Tom, Lisa, John, thanks for having me on this morning. Good morning. Great question, Tom. You know, what do clients want to do? Well, two things, really. Number one, they're reconditioning themselves to yield. Yields moved higher. We know that. It's been talked about. The curve's inverted. But they're trying to optimize their yield positions. Now, that means if you're an individual, you're pulling tremendous amount of money towards the front end of the curve. We see it in the flow data. We see it in the conversations. We see it in our own activity kind of across the curve. What we try to do is sort of encourage clients to sort of think beyond just tomorrow, to think a little bit beyond 3 months out. Very difficult to do. Try to get clients to sort of extend their duration, buy longer maturity bonds, and in doing so, kind of lock in today's yield for the future. We know that as you get close to a pause in the Fed cycle, bonds tend to do well. But if you wait for that Goldilocks moment when the Fed is either on hold or maybe even cutting, well, then you've left a tremendous amount of return on the table. The opportunity cost of sitting in cash goes up from this point, not down. And that's what we're trying to encourage clients. The second component is for your duration buyer, your pension fund, your insurance company, your long duration manager. Now, those folks look at this market and say, I don't need to be a hero. I can lock in the type of yield that an institutional investor typically wants, which is different than an individual, but 5 to 6% yields for 10, 20, or 30 years is precisely what that institutional investor wants. And so there's this kind of tension in the market. Consumers kind of moving towards the front end, institutional going towards the long end, and then all the macro that goes behind it. And so, we've seen bond markets fall down into a little bit of a range. We're at the upper end of the range for, say, the 10-year right now. But that sort of next phase of the cycle is precisely what bond investors should be looking at right now. It's not tomorrow, but it is coming.
Just quickly,
that's how we're trying to set up portfolios.
Just quickly, George, because you can do coupon clipping in the credit space, is the credit market immune to some of the very painful chop that is evident throughout many other macro markets?
Now, the credit markets, are doing well, and I think there's a clear segmentation, and the companies themselves, big, large, sort of well-capitalized, investment grade, and a large percentage of high-yield companies are in good shape. Inflation's not a universal bad. You put up the earnings reports of companies earlier, and you have a wide range of companies that are doing very well right now. It's a very segmented market, so credit selection becomes absolutely critical. But there are good companies out there, and those good companies are still paying attractive coupons. And so that coupon clipping and that compounding in portfolios is very, very powerful. Now, we're watching stocks move higher, just like everyone else, but we're sort of also watching the bond market generate sort of nice, solid returns and kicking off the coupon that you can then use to either reinvest, to spend, to pay out. You can do whatever you want with it, but that's that very different dynamic that we're seeing in the bond market today than we saw, 12 and 18 months ago. So it's that reconditioning of why do I own a bond and how should it perform in my portfolio?
Yeah.
We're having those conversations every single day. And so bonds are back. They're back in the central part of many investors' portfolios, and they're sort of aligning themselves, them being bonds, very nicely with equities and kind of help create that diversification in your portfolio.
Massive change. George, wonderful to get your perspective. Thank you, sir. George Bory there of Allspring Global Investments. I was in the cabin this morning, saw another taxi pull up alongside me. They have those commercials on top. There it was, 5%, open an account, 5%. Let's go. That's the change. I mean, that's a massive change.
8.5% annuities advertised. That's from my youth.
That's just a massive change.
Yeah.
Coming up, 8:15, about 30 minutes from now, Henrietta Trace of Vader Partners on the debt debate in
She'll
Washington.
fix it.
She'll fix it, all right. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. White House negotiators say they are making steady progress toward reaching a debt limit deal. In a call from Japan, where President Biden is attending the Group of Summit, Biden told them he's confident Congress will act in time to avoid a default. House Speaker Kevin McCarthy has said both sides may reach an agreement as soon as this weekend. The G7 nations will agree to work together to track diamonds from Russia. But Bloomberg's learned they will stop short of slapping Moscow with an outright ban. Earlier attempts to sanction Russian gems in Europe have met resistance from importer nations like Belgium. Those countries argue that such moves would just shift the diamond trade elsewhere. The 14 countries in the U.S.-led Indo-Pacific trade talks are close to an agreement on supply chain coordination. Bloomberg's learned a deal could be announced as soon as next week. The focus is on systems that would provide early warnings when countries see a risk of supply chains being disrupted. Democratic Senator Dianne Feinstein suffered serious complications during her extended illness. According to a spokesperson, they included encephalitis and a neurological disorder that can arise from shingles virus. Feinstein turns 90 next month. She was absent from the Capitol for months and has announced she won't seek re-election next year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Our viewpoint is that because the fundamental basis is still there, again, to your point, there's been some, let's call it bubbly conversations about AI, and that's something that markets have been responsive to. But until we see corporations really hold back on CapEx related to communication services and big data and cybersecurity, it's a tough area to really be, not investing in.
Eric Friedman there, the CIO of US Bank Asset Management. Some monster moves in the tech sector so far year to date. NVIDIA up by close to 117%. Biggest gainer on the S&P 500. Second biggest, Meta, up by more than 105% year to date. Just absolutely phenomenal. Michael Hartnett of Bank of America weighing in on AI this morning. AI for now, a quote, baby bubble. Goes on to say, bubbles in the right things, e.g. internet, the wrong things, e.g. housing, always started by easy money, always ended by rate hikes. What's interesting about this, of course, is this one is developing, if indeed you would characterize it as one, and I'm not saying that I do, but this is happening, Tom, against the backdrop of 5% interest rates at the Fed.
It is. Well, that's the folding the financial into it. What's the level of hysteria into the weekend? The three of us right now, before we get to Mandy Singer, what's the level of AI, ferment this weekend?
FOMO, big time. Missed out on this. missed out on this.
But is
You're wondering
Apple
whether you
up
should get in.
because of AI? I don't think so.
No, not Apple, no.
But other names are. I would say, though, it's sort of the one side is FOMO if you're an investor, and if you're, a humanitarian concerned about the demise of civilization, which is some of the articles, the tenor of some of the articles that I've been reading are really questioning the role of human beings in a society where robots can do it better.
I said this earlier. If you believe that, guess so long it hurts. Seriously, greatest insurance policy going. If you believe that, then you should be super long.
John mentions the bubble of this, and that's their fault. There's famed in Hanover, New Hampshire. In Hanover, New Hampshire, the Dartmouth bubble, and it's their fault in 1956, where four bright people got together and began to think about AI. So it's Dartmouth's fault. To provide further wisdom, 70 years down the road, Mandeep Singh steps in here on this frenzied debate. Let's just start with the camp of it. Is this something that's fermenting, that's just going to go away like it's gone away 7 times before, back to Google search and back to that fateful meeting in Dartmouth?
Well, so think of the evolution, right? In the last 10 years, what we have seen is machine learning coming to the scene and really enhancing the productivity in the sense that it can recommend you stuff which you may be thinking along. And this is the logical evolution in terms of the AI getting smarter, from machine learning recommendations to voice assistants.
So what's different now?
The difference is it can be your personalized voice assistant. It can be an assistant to a student who is looking to learn new concepts. And it can be so real time and so accurate that it will make you productive. And that is where we are going with this because of the amount of data, the digitization that has happened over the last 10, 15 years. I think the algorithms are getting smarter and smarter.
Easy to call this a bubble. It's always easy. I'm always reminded of this video. There's this great clip that gets circulated around the internet every now and again. I believe it's from the late 90s. Do you remember Sears?
Yes.
Remember Sears? Great.
Yeah, of course.
There was a journalist that went round, I think for 60 minutes. You might know what I'm talking about. And they went to interview an analyst about Amazon, why Amazon was priced in the stock market as a bigger company than Sears. And the journalist there very smugly looked at the analyst at the time and said, "This is ridiculous. Are you telling me that Amazon, this company that sells books, should be worth more than Sears? Than Sears? What's Sears?" A lot of kids watching this like, what on earth is Sears? I don't want to be that guy in moments like this, and I would suggest strongly to other people as well that you don't want to be that guy either. Is that one of these moments right now when we talk about this kind of technology and the changes that you're anticipating in the future?
It definitely feels like one, simply because every year there is a new buzzword. Last year it was Web 3.0, blockchain, but it never caught up to that level where you could think, it'll be that disruptive. Right now we are talking about the chip industry getting disrupted. We may not need as many CPUs as we used to deploy before because GPUs are more effective in parallel processing. The format of search may change simply because we're liking the format of summaries and, different kind of searches with virtual assistants. So those are the type of things where you're disrupting existing industries. I think that is what was missing with some of the earlier technologies and the buzzwords, and that's why I think this is more real.
There's a big question about whether all of the prowess in the AI race will be locked up in the Googles of the world, the Microsofts, or whether it will be a more democratic process of development around a whole host of smaller firms. What's your view of this? How big of a cushion could this have for a broad swath of the tech industry?
Yeah, so I think there will be evolution of standards. Think of, the evolution of internet. Clearly, there needed to be more standards just to, and I think regulators will come into the scene as well in terms of how AI gets developed, what kind of data are we allowed to use. Right now, the ChatGPT models are built on open internet data, as well as when you think about Google, it's using both open internet as well as its own first-party data. Same thing with Meta. Amazon, and all the internet companies have an inherent advantage because of all the data that they have.
So we've been talking about the Armageddon type of situation where robots can impersonate humans. We don't know who's what. You can have all sorts of manipulation. And, a lot of people are thrown out of work and have to rely on some sort of universal base income in order to exist. Are we heading toward that type of dystopian existence based on some of the automation and what you're seeing?
I mean, I think you can automate a lot of tasks, and where I think AI can make a difference is in terms of, let's say, autonomous software. I mean, people don't talk about it as much in this context of ChatGPT, but for me, auto driving is also ChatGPT type of a situation where you are leveraging large amounts of data, and you are making that decision in real time. So there are so many use cases where you can drive productivity as a result of the large amounts of data and processing that you have available. So I don't think it's going to be all the jobs disappearing or that kind of a situation. Well, but to me, it's about productivity and what helps you drive that productivity.
Well, let's cut to the reality. Yesterday was the annual Mrs. Keene. Can we just throw out some of these books discussion? And I'm holding in my hand David Blanchflower's classic, The Wage Curve, a giant of economics at Dartmouth, etc. Is AI going to replace David Blanchflower's classic book, The Wage Curve? Is AI going to replace Blanchflower lecturing at Dartmouth in macroeconomics?
I think AI can help you teach basic concepts in a way where, it creates a level playing field for students in a class. Not everyone can pick up the concepts right away. And this allows, somebody who can work through it, who has a personal assistant, and really may not get as much, Professor Blanchflower's time as he may want in the class.
Education has to change. I saw a really good take on this, that when you had the calculator, you had to change the math class. It's as simple as that. We're all going to pretend that we need to do half the things we need to learn at school when it's at your fingertips. It's never really made sense to me that education has not really changed with the birth of all of this technology over the last several decades.
And I think they're going to have to change real quick. And whether it's just simply removing the access to ChatGPT or those types of programs isn't going to be enough. It's going to have to be a different type of teaching with critical thinking and the use of, ameliorated kinds of devices.
Couldn't agree more.
I'm going to go the other way. What this is going to do is a separation of people that totally get it, have done the grunt courses, that have passed the exams, like Mandeep Singh, and everybody else is going to be faking it with AI. There's going to be an elite group, ever more elite group, John, of people that worship Alan Turing and did the hard work.
Okay. And will they have social skills? Will they have their work on the other things that you need?
I'm getting a recommendation for one Bloomberg of Friday of Lisa Positivity. So one of these Fridays, I will try to be discussing Armageddon and the potential for disintermediating humanity. But we'll get there.
Mandeep Singh, Bloomberg Intelligence. Was that meant to be constructive? Because that didn't sound constructive.
Well, no,
what was that?
No, I don't know. I mean, to be completely honest,
a little punchy, Mandy. Sorry.
I think that, look, these are the questions that people have been talking about, though. And it's not really that under the radar. Mandeep, is this something you've been talking about?
Well, clearly it could affect everyone's job, even research analyst jobs. So I think we are thinking about how
get to work.
Yeah. There you go.
Banana Rag Rana will be okay. The 2-year yield, John, I'm sorry, that's the story of the morning.
Okay, there's a transition. All right, Mandeep, thank you.
I'm sorry. I don't need AI to know that.
Very close to 430. 427, yields up every single day this week. We'll talk about the equity side of things in just a moment. The equity market on the S&P 500, 9 months highs at the close yesterday. David Bailey on a City coming up very, very shortly. Have you been in this market on the long side? If you haven't, you're starting to feel tempted. Are you anxious about doing so? We'll talk to David about all those things in just a moment. What do you always say, Tom? The courage to be in the stock market.
The courage, yes.
How much courage do you need right now?
The courage to be in there.
How much courage do you need right now? David Bailey coming up. Chairman Powell a little bit later this morning. We'll count you down to the Fed chair later today.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very carefully.
Nobody covers business like Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody? The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful. In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The economic data is slowing enough that the Fed is able to take their foot off of the brakes.
I don't think that we will see a hike. I think the Fed actually is at terminal.
If the Fed wants to raise rates, it's going to really hurt the economy.
We think the Fed has paused here, but there are myriad options for policy after that.
It's quite possible that we do get that soft landing that the FOMC is aiming for.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. On a Friday, it is a bull market Friday. We welcome all of you on radio and television. Where to begin, John? I'm going to go to the VIX under 15.95.
And the bond market, Tom, a two-year yield with about a 30 basis point range so far this week. We opened up at 398. The two-year right now, let's call it 427. That's been a big change. Encouraged by the words of President Logan of the Dallas Fed just yesterday, when she said the data in the coming weeks could yet show that it is appropriate to skip a meeting. As of today, we aren't there yet. She's leaving that door wide open to a move next month.
Skipping a meeting is the President of the United States, rude at dinner. It's one of those dinners, John, where they got 4 forks on the left side and 6 spoons, and there's a spoon above the plate I don't know what to do with.
Soup,
Biden's excellently.
No, that's a dessert.
That's a dessert spoon.
It's a dessert spoon.
I've been getting it wrong all the time.
Yeah, it's green.
I've always been reaching that for
John.
Bread on this side,
you start on
drink
the outside,
on this
come
side,
in.
and then
Thank
you come
you.
in.
Appreciate
Very
that.
good. Every green tea ice cream
Please,
the
we cleared
president's
that up.
missing. John, seriously, the president's standing up at dinner and he's coming back because he's got things to worry about, and that's part of this market lift.
It's part of the theatre. I think they want us to be talking about that. The president's abroad, but he's got his eye on the ball. He's going to leave for dinner early and have a chat about where we are in negotiations. Even if he was at the dinner, they'd update him on the negotiations. Fact of the matter is, when he comes back, there's some hope there will be a framework for an agreement. Fact of the matter is, and these are the real facts, the Treasury's cash balance has come all the way in from 140 last week, Tom, to something like $60 billion right now, $68 billion to be specific.
We got a really important global Wall Street guest to stay with us. And Lisa, this goes to what Citigroup can do. Tim Thien just reporting on John Deere with a 36% upside on his reaffirmation of a buy.
This week's chop has turned into this week's potential optimism or glimmers of shoots of something where perhaps people are taking some tail risks off the table, including the debt ceiling debate, to tie these two ideas together. So here's the question. At what point will corporate resilience really lead the way up in the sense that there is optimism and capital expenditure and, oh yeah, profits as people keep spending?
Nice lift to the market, John. SPX up 0.3% after that big day yesterday. Let's start the data with the VIX, 15.96.
Equities up by, let's call it 0.25% on the S&P 500. 2 decent days of gains on the S&P. Biggest two-day bop going back to April, I believe. The highest level we've seen since August 25th. And as you know, that was the day before Chairman Powell spoke on August 26th in Jackson Hole, Wyoming, talking up pain. We had some pain going into October, November time. And Tom, we're back to where we were, 41.98 at the close yesterday, 41.98 at the open when the chairman spoke in Jackson Hole.
A huge Friday to recalibrate. And of course, we'll all do that after the Thomas Laubach Research Conference with Bernanke and Powell and others gathered in honor of Tom Laubach, who came up with R-Star. Forget about the theory. Mostly for some people, it's about missing a bull market off the October lows. For others, it's recalibrating. And I'm going to suggest for many others, it's just the fear and maybe being in cash. David Balin advises this morning, Chief Investment Officer for Citi Global Wealth. You had the courage to be in the markets throughout all of this process. Reassess the courage right now. How do you have the courage to be in a market after this run to 42.22?
Well, it's not a cheap market, Tom, and that's not really the point. If you take a look at what's happened right over the last year, this is a perfect example of why market timing is absolutely terrible. And it's a question then of what you own and not when you own it, right? So it's what's in the equity portfolio. For a long time, last 12 months, we've been defensively positioned right into companies that are high quality with dividends and all of that, and that's paid off. And now you're seeing a rotation, right? And you've talked about this on your program into AI and tech, which makes sense because you're going through a revolutionary period of time, right? Getting exposure to these stocks and, more importantly, getting exposure to the companies who will use this technology, right, is going to be extremely important. And that should be in one's portfolio. And then there are pockets of value that are still out there, right? I mean, take a look at what financials look like today. If you really ask yourself a year from now whether or not financial stocks will be higher, you have to imagine that they're well capitalized. They're going to tolerate what's going on in the market now and the move away from deposits. But ultimately, this is essential to our economy, and it should not be marked down 30%. So there are things to buy. And the most important thing is to look forward as you go about buying them.
Well, let's talk about allocating to some of those themes. The answer to this question, I hear it a lot on financial news programs. How much should I allocate to one thing? How much should I allocate to another? Isn't that just highly dependent on who you are, how old you are, where you are in life?
Yeah, I mean, obviously, when you do, wealth planning and financial planning, you have to determine, what your spending patterns are, and you have to actually have a plan, right? But regardless of that, if you think about how a portfolio should be constructed, an equity portfolio should be one's best ideas, right? Exposure to different markets at different times. And there are some, great and obvious ideas. A great example today, which we never talk about, right, because we're so focused on the U.S. and on AI, is just the fact that right now you've got, foreign stocks at their cheapest level, right, as cheap as they've been since back to 1935. You've got the dollar at its highest level and rising recently, right, due to the rates. And yet no one talks about putting money overseas right now. And I think it is a gimme. And that's an example of where, you do asset allocation. But it's not. And so what's going to happen, I think, between now and the end of several months from now is people are begin focusing on 24, and they're going to want to have higher equity allocations than they do right now.
Have you been basically building your equity slice, or are you basically even weight when it comes to places like private credit that still offer a tremendous amount of yield?
Well, let's talk about that. So we've been slowly moving up our equities, right, in terms of our allocation to them. But the point you just made is extraordinary. And again, think about it from an investment startup point of view. If you can get in the fixed income market an equity-like rate of return and sustain that for the next 3 to 4 years, should you do it? Absolutely. And private credit is a great example. Bank loan products, a variety of mortgage-related REITs, things like that are yielding between 12 and 14% due to the illiquidity right now. And the credit risk that was there in 08 is not there now. These are the kinds of things that should be put into portfolios on the fixed income side. The other thing I wanted to mention is that, because you've touched upon this in a variety of your programs this week, is people who are focused on deposit rates or are focused on 1 month yields are going to miss the fact that now is the time to move their duration out and actually build resilient portfolios in fixed income that hold, for their cash portions, hold those rates for longer.
Given that that's your belief, you think that rates are going to come down. Is this period of time a golden period, ironically, even though the chop feels not particularly golden in any way, shape, or form? But are you seeing this period where you have an opportunity for outsized returns that won't come again after this period ends, after rates return and normalize?
Right, that's right, Lisa. I mean, you just talked about it in private credit. You're going to see the same thing in the bond market because we are investing into a slowing economy. There's no doubt that the Fed action, what's gone on with banks, in fact, even the resolution of the debt agreement that we're talking about this coming week, maybe, that's going to be take away stimulus. It's going to take liquidity out of the marketplace after it happens. So all of that's going to slow the economy. So we're now talking about investing for 2024, looking over the horizon of the slowing economy to what the market will look like next year. And that's really what's going on in the markets right now as far as we're concerned.
David, you mentioned opportunities abroad and you threw out some interesting numbers, and I just want to work through them with you.
Yeah.
DAX is at a record high today. Euro Stoxx 50 year to date is up close to 20%. Someone's buying it.
Oh, no, I'm talking about emerging market equities specifically.
Oh, you're going out to EM specifically.
Right, EM specifically. No,
so
obviously those markets, right.
Let's go there. What's happening there? Because Chinese data started to disappoint and some people are reluctant to chase that story. What is it about EM for you that works?
Well, what works is that you have a lot of companies, right, that are operating, whether it's in Brazil or in China, right, where their earnings stories are actually, picking up markedly. We saw a bunch of good even earnings from internet stocks in China, and they're being completely ignored, right? So we're overweight in that market because you're buying there at an incredibly good valuation. In Brazil, same thing. You're buying when they've done a great job. Real yields there are 9%. Their rates are going to come down. They're a beneficiary of the Chinese market, right? And they're going to benefit, I think, in terms of their stock price appreciation. But you have to do this in anticipation. When it's not fun to do it, that's when you have to do it, right? And that's the same thing you were talking about with AI, which is you have to think about which companies are going to benefit by building an AI department the way they've built their IT department. Those companies that decide to use it are going to be the beneficiaries of it, and you can identify them.
How do you identify them right now?
Well, you think about, just think about this. You think about, let's say, a consulting company. I can't name the, whatever.
You might not be able to.
Right. How is it that they're going to modify the business that they're going to provide to clients? They're going to teach AI. They're going to help companies build in AI. So in the consulting industry, you're going to find that. Companies that actually go out and, build models using AI in terms of financial services. And you can identify who's doing it because they're going to talk about it. My joke internally is that AI will tell you who's using AI. And that's what I mean literally. You'll be able to see which companies are actually using it. And that, to me, is going to be a determinant in how do you go about investing.
Let's go back to Walter Wriston, who would say that U.S. multinationals have international exposure. There's a small startup in Cupertino where something like 60% of revenues of Apple is foreign revenues. Can we go back to the old days where people can buy U.S. multinationals as a foreign proxy?
I'm not exactly sure because of the valuation difference. Let's flip it around and talk about, energy stocks in Europe. They're saying at a 40% discount to energy stocks in the U.S. Which would you rather own? They're both multinational.
With a big dividend.
That's exactly correct. So my view is you have to be conscious of valuation, right? Right now, everyone is very focused on the U.S. When we look at 2024, I think people are going to be focused on global investing much more than they are on U.S. investing.
Interesting. David, this was great and wonderful. I've said this a few times this week already, but great to see you in person.
Yeah, I know. I love the fact that we're all together. Right? Yes, exactly. It's fantastic. And Jonathan, you need to invest in the company that makes a dessert spoon.
I agree.
I think
got to make that happen. Is that at the top or is that on the side?
It's just at the top. You're doing good.
Yeah,
that's right.
Thank you, buddy. I'll keep doing that. Appreciate it.
I like the small ones.
David Balin, a Citi Global Wealth. Appreciate it. Let's get to the euro just briefly. 108 on the euro against the dollar. President Lagarde speaking to the media at the moment. The ECB needs to buckle up and deliver the inflation target. Interest rates still need to be sustainably high. I think that's a key word, sustainably high. They're determined to deliver their 2% CPI target. Now, remember, this is a single mandate central bank, Tom, and that target is 2%.
It's like it's Friday. I wonder if you people of the Bank of England's listening. It's like we got to toughen up and get this done. There's a few small extenuating circumstances, including a war in Ukraine.
Amazing. Claudia Samm's coming up. Brilliant. The former Federal Reserve economist joining us in about 20 minutes' time. Looking forward to that. From New York City with equity futures just about positive. Let's call it 0.2% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden is urging his negotiators to keep pursuing a debt limit deal. In a call from Japan, where he's attending the G7 summit, the president said he's confident that Congress will act in time and avoid a default. House Speaker Kevin McCarthy has indicated both sides may reach an agreement as soon as this weekend. Ukraine's President Volodymyr Zelensky will travel to Japan to join the G7 leaders in person. Officials have added an extra session to the summit schedule on Sunday to accommodate his schedule. Over the past week, Zelensky visited European capitals asking for more weapons. A new report from Barclays says a Netflix addiction is turning into a structural drag on the Japanese yen. According to strategists, Japan's so-called digital deficit stems from payments to overseas tech companies such as Netflix and Amazon. And they say a continued expansion will put pressure on the yen. Republican Senator Tim Scott reportedly will begin airing TV ads in Iowa and New Hampshire next week. According to the Associated Press, Scott also plans an announcement on his potential run for president Monday in his hometown, North Charleston, South Carolina. Last month, Scott formed an exploratory committee, allowing him to raise money while weighing a White House bid. Shares of Foot Locker are plunging. The sports shoe retailer cut its full-year sales outlook and reported first-quarter sales that fell more than 9%. Foot Locker also said that merchandise inventories were 25% higher than at the end of the first quarter last year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
The market's not pricing in a recession, far from it. I think the market's pricing in normalization. If we actually do enter a recession, and in our view, it's going to be a recession, because of the bank lending standards, because of the lagged impact of rate hikes, as the consumer savings buffer runs out. And now we might even have fiscal drag. I think the only way to get a debt ceiling deal is to get that fiscal drag.
Priya Misra there. the head of global rate strategy at TD Securities, going into a really interesting weekend where we're looking for some kind of agreement, a framework for a deal between Kevin McCarthy, the Speaker of the House, and the President of the United States, a deal that could get through Congress just as the Treasury cash balance keeps coming down over the last week or so. Going into that mess, if you can call it a mess, going into the opening bell, about an hour and 13 minutes away. We've had a decent rally into Friday over the last 2 days or so. On the S&P, we had a bit more weight to that rally. On the S&P right now, positive by 0.2%. Yields are shifting higher again on a 10-year, 366. On a 2-year right now, 426. Starting the week at 398, ending at, Tom, close to 430.
Did Lagarde just take the stuffing out of this in Friday enthusiasm?
Gave the euro some life.
Yeah.
Pushed it back through. 108.
You wonder what Powell and Bernanke are going to do. Was it 11 a.m. this morning? Are they going to do the same thing? Boom.
We'll see what Chairman Powell... If Chairman Powell says what Logan said yesterday, then you've got a big move on your hands.
Yeah.
I don't know how he manages that later.
You know, I mean, I'm day trading triple leveraged all cash fund. It's been working out well.
Working out? Nice.
SPX 4200, I'm getting grayer by the moment.
What kind of yield are you offering these days, TK?
We got a coupon, and seriously, that's the theme this morning. George Bory, there's a coupon out there. David Balin, Citigroup, there's a coupon out there. Priya Misra, there's a coupon out there. A lot of people like me are living when, you know, there's no yield.
It's a different market.
And Lisa, you've been great on this. I mean, it's not just 3 months. You know, you can go out a little bit further.
Well, that's really the weight that's kind of pulling people from getting too bullish on stocks, because why go into stocks if you can get 5% in bonds?
It's going to be interesting to see. Let's go to Washington right now. Emery Horton in Japan. So instead, we're in Washington. Director at Veda Partners, Henrietta Trey's, with serious Capitol Hill cred. Let's translate the reality of this Friday, Henrietta Trey's. And that's the idea of recess. Ready, set, there's a great crisis. Wait, Senator Schumer's going to say, no, we're going to recess. So we're running out of money. You and I have been in the cash room at the Treasury. We're literally going to run out of gold cash notes. And the senator from New York is saying, recess?
It's incredible. You can really watch the Treasury Secretary. You can watch the bulge bracket banks and their predictions, but you can actually set your watch to the congressional calendar to figure out when they're going to pass a debt ceiling bill. That's what I do. And it works every time. Just pay attention to the congressional recess schedule for sure.
What does it say right now?
Right now, it says that we're probably going to see bill text on Sunday, Monday morning, maybe. Speaker McCarthy will file the bipartisan bill that he and President Biden's team reach over this weekend. They will hopefully not vote on a bill in the House until Wednesday or Thursday of next week. Anything before that, and I'm very anxious about a TARP-like moment where the bill will fail, because the House is moving first here, which means the Democrats on the House side, who historically provide the bulk of the votes and the critical votes for a debt ceiling hike, are not going to have political cover from the Democrats in the Senate having voted first. So we're going to see the House move first. And I hope that there will not be a vote until Wednesday or Thursday of next week. At that point, Senator Schumer could call the caucus back. He has indicated that he will call them back within 24 hours notice. But 11th hour in D.C. really does mean the 11th hour. And they could well not come back until Tuesday, May 30th, 2 days before the X date, and pass the bill in the Senate next Tuesday or Wednesday. Well, that's what I'm bracing our investors for. That's what I'm expecting.
Henrietta, to that point, what is the risk that there is a technical default because there is a mistake, that someone mistimes this, that there is a bill that gets rejected or intransigent members of a party?
I do not think that there is any risk of that. To be honest, I am afraid of a TARP-like vote in the early part of next week. If Speaker McCarthy puts a bill on the floor Monday, Tuesday, Wednesday, I think the odds of a failed vote are about 40%. But that's a good week before we actually need the bill to pass. I think that's your biggest risk point. After that, I understand there's a lot of hay being made about, hey, the bill needs to sit for 72 hours. We need 10 days to get it through. If you're from the Senate, if you're from the House, if you've seen these bills come into law before, they can work all night long and get this done. And in fact, they will. I think the risk of default is 2%. I don't buy the hype. I have not bought the hype this entire process. You guys know, I don't think there's a risk of default.
So then why all the hype made by Congress members, made by the president himself? Why all the discussion about how this is not anywhere close, given the fact what has changed over the past 2 weeks?
I mean, quite honestly, if you want me to get on my soapbox for just a little minute, the last time we had a balanced budget was under the Clinton administration. And instead of using that surplus to pay down the deficit. What do we do in 01? We pass tax cuts. What do we do in 03? We pass more tax cuts. We blow out the deficit, continue doing that into the Obama years, did it again in the Trump years, $7.8 trillion worth of deficit hikes. And now all of a sudden we're in the Biden administration post-COVID with looming $3 trillion tax expirations happening in 2026, and we're talking about $500 billion worth of deficit reduction. It is a political show that is designed to say, hey, the Republican Party cares a lot about federal spending. They are fiscal hawks. They care about the deficit. No new taxes. And Democrats have to explain what it is that they support spending money on, TANF or working family aid, the energy department, the energy tax credits that were just passed. It's really just about scoring political points. That's what it's always been. And that's where we are in this charade. And now we're at the 11th hour, so we're going to stop posturing and actually vote on a bill.
I would suggest the charade began, I believe it was in New Hampshire, with George Bush Sr., where he got run over on the tax verbiage that we've been living for years and years. Let's assume that tax verbiage doesn't change. So what happens next? Obviously, everybody's going to want a tax cut. Everybody wants a free lunch, right?
Better believe it. So in 2025, right after this next presidential election cycle, the entirety of the 2017 tax cuts on the individual side expire. The SALT deduction comes back in, but all of the individual tax rates go back to their 2017 levels. So at that point, we're probably going to blow out the deficit again by temporarily extending those packages for another year or two, just like we did in 2010 and again in 2012. If there is a red wave in the 24 election, what you can see is a material reconciliation bill that is basically a repeat of 2017. That was a $5 trillion tax bill, $1.5 trillion of which was deficit financed. So you can very easily see that all over again, although this time it will be more expensive in 2026.
Rinse and repeat. Can't wait. Henrietta Trade's there, Aveda Partners. I think you've got a sense for how Henrietta feels about all of this. Rinse and repeat until you can't anymore. And that, Tom, is the problem. The issue is we've been talking about this for a long, long time, and that debt pile just keeps on growing, keeps on growing.
Yeah, it does. And what's so important here is the free lunch we've had from our technological superiority, maybe our demographics, maybe the immigration push of a number of years ago, where we've been able to go to Bernanke and Powell this morning to other factors and a reduced R-starred that doesn't get run over by reduced growth. And so we've been able to do this house of cards, if you will.
My problem is that the political posturing totally masks the real discussions that need to be had. Where are the areas of growth that you're investing in, where debt is good, and where is debt bad, where it's not necessarily creating efficiency, and or even healthcare, et cetera, that is helping people? How do you fix it? And there just isn't an honest discussion when everyone's just trying to score political points.
Never, and that's the problem.
That's the problem.
We talked about this earlier this week. If you can get 2 points for passing proper legislation, or 3 points for fighting, and fighting's easier.
Yeah.
Ding, 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 I'm going for points. And they are 3 points for fighting.
There's something that's interesting, though, about the fact that Republicans don't think that this is winning points anymore to have the U.S. default. And that is a shift, right? Because all of a sudden, there does not seem to be anyone saying that this is positive. And at a certain point earlier on, some people were saying, well, maybe it's like, do or die. This is going to be a good thing to score political points. No one thinks that anymore.
I'd modify that to say some Republicans. To support Ms. Trace, here's CBO, total receipts. The middle of the pandemic, 16%, then 18%, now 20%. So we're getting tax receipts back up to that historical norm, 21, 22%.
The luxury of issuing treasuries, you get to say a lot of stupid things without many consequences. At least that's been a story so far. In the next hour, Jay Pawlowski, who's been buying a little bit of tech. Look out for that conversation. Emily Rowland, alongside Jim Karen and Morgan Stanley from New York. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg surveillance on a Friday. Thank you for being with us. 1 hour to the market open. Lagarde maybe pulling equities back here with comments out of Europe. Lisa saw the euro go 107 to a 108 handle. Slightly stronger. We've got to raise rates. But there we are, Lisa. Just in the last 10 minutes, green on the screen. Futures up 12 again.
People really have not wanted to buy into this rally, and suddenly the tone has shifted this week, and basically it's sort of, we've been missing out, and it seems like there's some sustainable trends under certain aspects of the market. I'm not going to get conviction behind that. There's little conviction anywhere right now, and I think that really, that's what's made this such an interesting year.
My amateur take is it's not fear of missing out. I got to get on board equities. It's much more people who have placed bets short. Witness the very nice statements from Carl Icahn. It's great when somebody with that esteem comes out and says, oops, I was wrong.
Or how about all the people who are waiting to buy the dip and the dip doesn't come? What do you do with your cash?
Well, that's the fundamental feature here. The VIX under 16 to me is a huge deal, 15.97. There will be a Fed discussion at 11 a.m. The Bloomberg world will stop. Look to Michael McKee and others for interpretation of a conference, and it will be with the chairman of the Federal Reserve System, which is always of great import. But far more, it will be in honor of an economist who came up with the idea of R-star. You know John Williams of the New York Fed. This is Thomas Laubach, who, if you're at Denison University and you're studying economics in German, you know who a German economist is that everyone's talking about. That would be Claudia Sahm, and she joins us this morning from Sahm Consulting, all her work at Denison in Michigan, about Tom Laubach and this crazy thing, R-star. Claudia, I'm going to cut to the chase. Laubach and Williams came up with this theoretical construct that's been a gift because we've had a lower R-star, which has allowed us to have a ginormous debt. Do I have that right?
Yeah, I think the level of the interest rates, the quote unquote R-star, they do matter. I mean, one of the big reasons that the deficit, the first year under President Biden, or the second year, you started seeing, as the Fed raised interest rates, the cost of servicing some of this debt in the treasuries has been, that took a hit in the deficit. We have to, these relationships are there. I will say when we get into R-star territory, I get a little uncomfortable just because I think conceptually it is beautiful. But it's not, our world right now is not beautiful. So we don't know R-star, and you've seen the Fed move it around and rerun. It's hard for me to stomach. But if we get to a good place and they don't raise rates, hey, I'll take it.
What are the ramifications? I totally agree with you that it's a beautiful theory and all that, somewhat like DSG and Clarett and Gertler, great. But the fact is we live in the real world, and Richard Clarett has been very brave to say that. But Claudia Sahm, if we get a higher R-star, and with the bigger debt and the new higher interest payments the government has to make, does the American house of cards fall apart?
I don't think so. If there's falling apart in the next few weeks, it's going to be the debt ceiling. This pressure it's putting on the deficit and the government's borrowing, this is not my first order concern. It is the case that we went from very low interest rates to we moved up really fast. Like the Fed moved the interest rate up, and that was feelings about what our star was that they need, because they haven't been able to cool off the economy. Like that's very frustrating. And so then they translate it to we're getting our star wrong. We push it up. So the logic of it is really tough to see right now.
Claudia, today, how much should Fed Chair Jay Powell push back against the idea of rate cuts? Can he do anything to make people stop believing that they're going to turn the other way by the end of the year?
Oh, he is totally preaching to the choir today in terms of the Fed staying with the high interest rates. I mean, there's just no way someone's going to be like, hey, are you going to cut rates so that you are lined up with the markets? I think they're going to get a lot of support for what they've done last year and a real drubbing for what they did in 21.
On the flip side, Lori Logan of the Dallas Fed came out yesterday and was saying that she's not there yet. The data doesn't really confirm the idea of a pause for her, and she seemed very open to another rate hike in June. I'm wondering, from your vantage point, do you think that could be destructive for the financial system, that the smaller banks that have already experienced some stress could be taken over the edge with an extra 25 basis points, or do you think that it really would be of little consequence?
It was just 25 basis points, right? This is not a make or break in our economy. What I've been really impressed with, listening to the chatter from the FOMC, and there's been a lot of chatter, you have such a mixed bag. Like Bostic said, he was ready to pause, right? So you have members of the FOMC, participants of the FOMC, who are giving us lots of different messages, and it is so much a relief to know that inside the building they must be having a very robust debate. And that's what we need right now, is to make sure people are really thinking through it.
Claudia, you've on the high ground. I'm going to go to Olivier Blanchard, who uses work out of VCU and talks about we have an emotional point on inflation where we begin to fall apart. He calls it a sentient point where inflation matters. You are acclaimed for your work on our limited attention about inflation. If we have disinflation, does America's view of inflation calm down and cool?
Yes. And not because they're watching the CPI, it's like their lives. I mean, as food prices are going down, that's really important. That's an important piece for households. I don't think there's a magic number where it all falls apart. I think it'll be some external event that causes it to all fall apart, which the turmoil in the banking sector was a real thing. And I was very surprised that they didn't pause while that was still in motion, like the 2 meetings ago. But they are just laser-like focused on getting inflation down. And I've been asked, hey, what if they, could they just stop at 3 on inflation? It's like, no, they're going to 2, one way or another.
Claudia, but the heart of the matter here, and we say this on the week of the passing of Robert Lucas, the giant of Chicago, Claudia, the fact of the matter is the institution is ex post. How many data points of service sector disinflation do they need to see before they actually do what they should have done X number of months ago?
Yeah, so they continue to chop up inflation into the piece they're worried about. Like Supercore did not exist before this, or at least wasn't talked about so broadly. The thing that worries me, and they know this, inflation is the last place that their rate hikes show up, because it takes time to filter through the economy. And we've gotten some signs like the producer price index, looks like the mismatch in openings and people searching for work, that's starting to close back. They're getting all kinds of signals about where inflation is going to be in the next 6 months, and they're just shrugging it off. It's like, we got to keep going. We got to keep them high.
Yeah.
So
we're speaking with Claudia Sahm, former Federal Reserve economist, about the state of play in monetary policy. A lot of people in the markets have moved on. A lot of the people in the markets are saying the macro story right now isn't really given much. And what we're looking at instead are developments like artificial intelligence and technological advancements that could change the way we work, that change the way we have education, change the way we live. From your vantage point, at the Fed, how much are they looking at some of these technological advancements as either disinflation or inflationary? Putting it into their model and understanding what is the right parameter to even look at the current data.
Yeah, AI is not in the Fed's macro models or its monetary policy advice. And frankly, I think it's appropriate right now. The Fed is really about stabilizing the business sector. AI and all what we tell are going to be amazing innovations, that's 5 years out, 10 years out. Like, that's not going to be big enough to make a dent. Now, you want them to bring it in when it's clear. I mean, because they do some long-term modeling also. But just like with the supply shocks, they didn't, from COVID and the war in Ukraine, they didn't have good tools, or this isn't even in their models to have this kind of supply shock.
Well, I guess that this is one of the reasons why a lot of people are saying they just don't know, right? And so that's the reason why their words are kind of holding less clout in the market, because they don't know which parameter they're in. They've made that apparently clear. So at what point do you feel like the Fed does have the high ground when it comes to understanding where we are in terms of the macro regime and what era this really relates to?
Yeah, they're going to celebrate the day we hit 2% on a sustained basis. Right? That's what they're looking for. I think they get comfort in some of the numbers. I personally think they've gone past the point of being data-driven. I mean, if they're being so like, look at the data, that means every time something comes out, the markets react to it. They shouldn't be creating volatility.
Claudia, we only had you on to get an update on the SOM rule. Explain the SOM rule. Trying to game, everybody watching who's trying to game recession is hanging on every word you say. We need a Friday SOM rule update. Let's have it, Claudia. How close to recession are we?
Nowhere near. The unemployment rises very slowly, and that takes some time. And the SOM rule is if you just have a 0.5 percentage point increase in the unemployment rate relative to the past year, you're in a recession, 2 months, 3 months into a recession. It's not a forecasting tool. It's really about, are we there? And it's 0 right now. And given how slow unemployment moves, normally COVID was very different, it would take quite a while to get from 0 to 0.5. So we're not there. But again, it's an empirical relationship that held in the past. Almost all of our empirical relationships are blowing up in just labor. It was so conflicting with the data. So it's especially tough here, and I do appreciate the humility that Powell gives when he talks.
Claudia, thank you so much. Claudia Sahm, former Federal Reserve economist, here as we move to 11 a.m. and an important Federal Reserve moment with Chairman Powell and the former Chairman Bernanke. There are headlines that come out that give pause. The gentleman from Australia will pause.
Morgan Stanley CEO James Gorman is planning to step down within the next 12 months. That is the headline that is currently crossing. You can see that shares of Morgan Stanley lower by about 1.7% as you do see that immediate knee-jerk plunge. Remember that they are having their annual shareholder meeting today, so perhaps this is the big takeaway from the whole affair. James Gorman, who has led this company and frankly made some acquisitions that a lot of people really shrugged at, he really expanded it in a way that took it to a new level.
Out of Columbia and then to McKinsey, but with prodigious mathematical skills. And what's interesting here is he is revered for what he did with wealth management and the acquisition of assets for Morgan Stanley. Just one to pick out is Boston's Eaton Vance is one example. But to see this, and I should say in the limited headline we have, there's no discussion of the chairman word. So you wonder what that dynamic will be as well.
How about who the replacement's going to be? What's the bench? Where are they going to look? And then what does this mean in terms of what their longer-term trajectory is, especially after the successful acquisitions and their ability? But just to give you a sense, this was announced at the annual meeting. So this is going to, and this is an answer to your question, he is going to be executive chairman after stepping down as chief executive officer.
Who could we speak to that could talk about the bench at Morgan Stanley? And that would be, I don't know, Ellen Zentner or, Jim Caron will be on with John Farrow in the next hour. No, that's not the bench. Expert at the benches of Wall Street firms is our Bloomberg Someday They'll Be CEO correspondent, Shonali Bassick joins us. Is this a surprise that Mr. Gorman will step aside?
The timeline is certainly a surprise. We knew that it would be coming one day. He's been at the helm for a very long time now, and we know that Morgan Stanley has been prepping the bench for a while. Think about how many people have grown up under James Gorman, have left the firm, and the two men under him right now, Andy Saperstein at the wealth business and Ted Pick, they're homegrown. They have been there for a long time. They've been at the most pivotal moments of the firm, up and down. That is Ted Pick at the Institutional Securities Division really helped make this tough transition from cutting and adding to the fixed income business, for example, help competing as the top prime broker on Wall Street in the equities business as well. And over at the wealth business, Andy Saperstein, former consultant, longtime lieutenant to James Gorman. Now, the question is, and waiting for the headlines on this, at what point are they going to announce who is taking over?
Well, let me just read the exact statement. This from Gorman at the firm's annual meeting. He said, "It is the board's and my expectation that it will occur at some point in the next 12 months. He's talking about his departure as chief executive officer and becoming the chair of the board. That is the current expectation in the absence of a major change in the external environment. Also a key question, was this a decision that he made independently for a lifestyle kind of issue? Was this some sort of strategic shift by the board made basically without necessarily his desiring this departure?
You know, I think that's an interesting question. It's hard to have any evidence of something like that. James Gorman has just made this firm into a behemoth. Remember, when I started covering Morgan Stanley, they were worth much less than Goldman Sachs. Now they are worth much more. That divide has just increased despite many, many doubts. I remember years ago, there was a conference call, and you had analysts asking why he wasn't raising the bar more for Morgan Stanley. And you had James Gorman stepping back saying, be patient, we've got this. And ultimately, he was right. And so, you know, again, there's been a lot of consistency here, Lisa, when you look at the next level of the firm. And again, I think this is very classic Morgan Stanley fashion. They announce one change, they give you some time to absorb it, then they announce the next big move.
So it's interesting to me, the point about unless there is some sort of shift in the market conditions at a time when people have been talking about a financial crisis that never transpired, and now people are talking almost about stasis or this calm that has really percolated out. Is this viewed as sort of a calm period, a pond with the ducks sailing across, even if there's paddling underneath, where they can actually make shifts like this without any major disruption and do it easily?
Well, how fascinating to talk about this right before people are worried about a potential recession. Morgan Stanley has seen some of the worst days through 2008. They remember what it felt like. So this is some calm, isn't it? That is saying it is calm enough to start to transition. And by the way, look how many CEOs are changing on Wall Street. This is the time for the next generation to step.
Well, okay, maybe. Paul Davis wrote this 5 months ago for Bloomberg. Thank you to the Washington Post for publishing Paul Davies. And I'll never forget the headline. Goldman Sachs is, quote, far, far behind Morgan Stanley. It's all about asset management, right? It's an Eaton Vance thing. I don't know how E-Trade's worked out as well. But where does Saperstein fit into that? Because my basic take here is Ted Pick's sort of the older guy. He's got the swagger of Morgan Stanley, and Saperstein is watching paint dry, making all the money. Do I have that right?
It's a pretty good characterization of what's going on. Listen, in the trading business, these are a bunch of loyalists. This goes back to when Colin Kelleher was there. You worry about the traders leaving without a solid person in charge that they trust, that leads the troops. But to your point here on Andy, he also has tens of thousands of financial advisors across the United States. Those are less swashbuckling, let's say, than maybe the traders and investment bankers, but it's steady and they bring in the big bucks, like you said.
Who decides at any firm who takes over?
The board. But remember, as we've been talking about, James Gorman is on that board.
Okay, fine, he's on the board, but how independent is a Morgan Stanley board versus a guy who many people would suggest is a CEO of the decade on global Wall Street?
I think that's a great question.
It's my only good one of the day, so go with it.
Morgan Stanley's board is pretty diverse and very committed. And remember, it's changed quite a bit in recent years. It has talent from the former Securities and Exchange Commission, from Japan, given their deal with the MUFG during the financial crisis. So it is quite independent relative to a lot of what you're seeing on Wall Street. And that's what kind of makes this succession plan successful in the eyes of Wall Street. It's consistent, and it is broad, and it is diverse in the way it's being sorted through.
If you're just joining right now, the news of the day, Morgan Stanley CEO James Gorman is planning to step down within 12 months. This he made in an announcement at the annual meeting. The shares immediately popped lower about 1.7%. They've retraced a lot of that down near just 0.6% as people digest the news. It does seem like, Shonali, this has been in the works. This has been something they've been planning for, and they pulled the trigger a bit earlier. Is there a sense of shift within the strategy of this company going forward, or do you think it's stay the course, keep the homegrown talent, and keep on plugging away?
It's already changed so much. To your point with the big acquisitions, they've always had wealth as a huge driver, asset management. But the asset manager, again, 5-6 years ago, you couldn't see Morgan Stanley becoming more than $1 trillion in asset management. That has changed, and it changed quickly with acquisitions. So they've already changed. The question is, if they choose one man or the other, which part of the bank could suffer from any potential attrition or concerns around who's leading?
Off the BQ screen, Goldman Sachs 1.03 price to book, Morgan Stanley and James Dimon like 1.53. And I'm sorry, the guy is so modest that he's underplayed what he did with managing money. I mean, that to me is just the massive theme here. And you've said that he will stay as an executive chairman?
Yeah, he's going to be chair.
What do they do?
What do they do?
What do executive chairmen do?
They sit around and they make sure that nothing goes wrong, and they come back if things do go wrong. I mean, listen, the initial market reaction tells you a lot. He's iconic at the helm of Morgan Stanley. He's changed the firm more than any other bank has changed in the last decade.
Shonali, thank you. She is our chief Wall Street correspondent. There's no other way to put it here, and it'll be interesting to say the least. Patiently waiting, which is what you do when you're in economics at the London School of Economics, as we look at what's going on Wall Street, is Kay Jin. She has been absolutely spectacular about the synthesis of the political economics and the changing political economics in China. And as you do with Elizabeth Economy, now working at Commerce in the U.S., there are books where you say, oh, damn, this is the one this weekend. The New China Playbook, Beyond Socialism and Capitalism, Kay Jin, it is the academic read of the moment on China. Thank you so much for joining us in New York.
Thank you, Tom.
Just simple, where'd the capitalism go, that model of Chinese capitalism, and what does the new post-capitalism look like in China?
Capitalism is still there. It's just never going to be above politics. And there's going to be more regulation, more monitoring going forward. China's going to avoid trying to become an American-style capitalist society and want to be a bigger and smarter Germany, focusing on industrial, technical power. There are new goals in the new era, a new generation to shape the contours of the economy. Lots of things going on.
We got some news about Alibaba as one example of one of their capitalist success stories, spinning out their cloud business, potentially because of some of the stress they were coming under from the Chinese Communist Party. How much is this new push hampering the economic capitalist push that it's been focusing on for a number of decades?
It's going to be a constant struggle, a tension between more growth, more innovation, and more regulation. And what we're seeing is China's government coming down pretty harsh on monitoring or trying to prevent monopolies and protecting consumer data. But the economy is in its worst state, so they need the private sector and they need innovation.
I'm going to ask a really unfair question. Are people happy?
Ask people on the street, and I think overwhelmingly a positive yes.
Really? So this is actually very much against the common feeling in a lot of Western media that people are kind of buckling under the constraints of some of the censorship and the oversight. You're saying that on the ground, people like this direction, that they think that it is the correct way to go.
Well, the last 3 years haven't been helpful, so people have been unhappy, especially towards the end. But in general, if you ask any random person, they will feel like, my kids are getting educated, their opportunities, my future is pretty bright, until recently, but things are opening up. So that's changing.
All right. So we're talking here about China as you have the G7 meeting taking place with a lot of Western leaders getting together and trying to figure out how to compete more directly with China, except to keep it from becoming antagonistic. Can you get a sense of just how antagonistic this is getting, especially given the sort of Central European or Central Asian meeting that Xi Jinping is holding on the other side?
Yeah, the temperature needs to be taken down, but we have to understand that different countries view the security and economy in different ways. They view China differently. differently, and China understands that heterogeneity. And so going forward, the U.S. and China tensions are really important, but we see the leaders trying to take the temperature down as well. But misunderstandings don't help, and they have to keep an open dialogue. Communication is absolutely key.
Does China still want to be the #1 economy, or is that kind of off the table?
If China can grow fast, 1.5 percentage points faster than the U.S., which is feasible still, it will become the largest economy in a little over 10 years. Let's not underestimate the 600 million people in China today that is still with less than $300 of income per month. That's a huge boost to consumption power.
We've been talking about Morgan Stanley and James Gorman stepping down. This relates to the China story because there has been a lot of discussion about Morgan Stanley and Goldman Sachs, among other Western banks, getting out of China, that the temperature there has gotten a little too hot for them and the political interference. How much is this China growth going to happen without Western companies participating, without Western companies really having much of a presence there at all?
No, China absolutely needs Western companies, Western investors there. But I'd say that the financial system is actually the sector where China is most open to welcoming foreigners. Lots of licenses handed out to foreign institutions. It's just currently the severe loss of confidence for our private businesses are making investors hold back.
Kajin, thank you so much for joining us
Tom.
today. With the London School of Economics, I really can't say enough about the new China playbook. It's just the right size to get a huge perspective here on all the changes going on in China. We need to return to an historic moment on Wall Street. James Gorman announcing at their annual meeting that he will move away from duties as a chief executive officer. It would be good to speak to someone who arched from John Mack to James Gorman, and that would be Allison Williams, of course, leading all of our banking coverage at Bloomberg Intelligence. Allison, what a shift in the Morgan Stanley of John Mack and before to what James Gorman wrought. What did he wrought?
He really shifted the business towards wealth management and away from sort of the more volatile institutional business of trading and investment banking. And to be clear, even though there has been this shift and there is this focus at the firm, the institutional business has still thrived under Gorman. And I think the changes today are sort of a natural progression. It was about 2 years ago that the firm had named Ted Pick and Andy Saperstein as co-presidents. Those are the heir apparents. And Ted Pick really having transformed the institutional business. He did a great job with fixed income trading, took over equities trading, and sort of moved up. And Andy Saperstein, Ted Pick, really having transformed the institutional business. He did a great job with fixed income trading, took over equities trading, and sort of moved up. And Andy Saperstein running the bigger wealth side of the business.
David Brooks in the New York Times, Allison Williams, wrote an essay years ago about the smooth guys versus the nerds. And so you've got, as a generalization, the romance of banking, the meet and greet of banking, the transactional nature of banking versus managing money and picking up a fee along the way. Which has the high ground at Morgan Stanley right now? And can they both coexist given whoever becomes CEO?
I think they can coexist. It is sort of the latter that has grown in importance, the wealth and recurring fee business. And I think, Sonali was talking about sort of the stock of Morgan Stanley versus the stock of Goldman Sachs under Gorman's reign. And from an investor standpoint, the investors do tend to favor a more stable recurring revenue type business, and that is more the wealth and asset management business. We always like to remind people that it's a business not immune to market pressures. If the market has a dramatic downfall, that will reduce those fees. But as we saw during the pandemic, in very volatile times, the banking businesses, the M&A and equity underwriting, if you will, those can actually come to a halt. And so that's the big asset base, the trillions of dollars that they've garnered, that won't go away overnight.
Allison, can you speak to what Sonali Basak was talking about? This is the time for younger blood to take the helm, for people who have been in charge for years to step aside. Is that really the feeling that you're seeing percolate on Wall Street?
I think it is story by story, but it is, I think, a time, also, as you all were discussing, it is a time of relative stability, right? There's always uncertainty. There's always concerns about the economy. There's always concerns about monetary policy, but I think you do want to sort of pass the baton in a relatively calmer period. We saw this with Lloyd Blankfein, if you recall, several years ago when he said, you know, things are stable right now. It's time to pass the baton before we kind of go into the next round of some kind of volatility. And that was the right move, right? So when the pandemic took hold, David Solomon had been in place. And so I think Gorman is making those comments. You did see that he gave a caveat, you know, if there is some kind of disruption, he left that door open, that it will be a smooth transition.
Allison, thank you so much. I know a busy day for you. Allison Williams of Bloomberg Intelligence on the news that Mr. Gorman will step aside as CEO. There's another major story going on right now, and it is moving markets. Futures up 15, Dow futures up 105, and the VIX in a big amount from 15.97 and 0.10. That's a big move. 15.87, and these are stunning headlines at the conference that Powell and Bernanke will be with Thomas Laubach's colleague, John Williams of the New York Fed. And Lisa, this is really strong statement in writing by John Williams. He speaks of the relaunch of the R-star rate, R-star interest rate back to pre-pandemic level. And really the very key headline, pandemic didn't end era of very low rates. There's your market lift.
Echoing what we heard from the IMF, and everybody poo-pooed what the IMF had to say. Oh, you guys are stuck in the olden days, and here comes John Williams saying the same thing. We're going right back to there, which really was the belief that a lot of people in the market has as well. However, that said, what does this mean in terms of what Fed policy is? Well, remains to be seen.
And you see this off of what we saw from Lagarde 2 hours ago, moving euro 107, 108, where they're going to go to higher rates to calm a much more difficult inflation. But this is, what are we going to see from Bernanke and Powell here at 11 a.m.?
The implication from John Williams is they're going to hold rates as high as they need to hold them to get us back down to a level that they see as the same as it was before the pandemic, despite some of the discussion about a new era.
The headline there, the pandemic didn't end era of very low rates. That from John Williams of San Francisco in New York. Much more to come on Bloomberg Television on the Pacific Rim. Jay Pulaski, good morning.
What a morning so far. Live from New York City this morning. Good morning, good morning. Equities building on the gains. Equity markets at 9-month highs. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, the S&P 500 closing out the week near 9-month highs as President Biden looks for a debt deal this weekend and one Fed official leaves the door wide open for June. We begin with the big issue. Investors looking to see if Powell walks through it. The Fed chair set to close out quite a week for Fed speak after President Logan of the Dallas Fed left the door wide open for a move next month, saying the data in coming weeks could yet show that it's appropriate to skip a meeting. As of today, we aren't there yet. Governor Jefferson signaled he's leaning towards a pause, and President Bostic left most of us confused, saying, quote, a pause could be a skip or it could be a hold. Bank of America's Mike Gapin doing his best to wrap it all up. Our baseline is they're done. There are a lot of things we need to get past in order to clear the decks for another Fed rate hike. And this is what we need to get past on the calendar. Payrolls on June 2nd, CPI on June 13th, and a debt ceiling X date somewhere in between. Our team coverage begins right now with Bloomberg's Anne-Marie in Japan, Mike McKee here in New York. Mike McKee, the chairman, a few hours away.
The chairman a few hours away, and that's where you're going to have to look for any news. We had John Williams, the president of the New York Fed, speaking this morning, and Governor Mickey Bowman, both of them making news, but not talking about current monetary policy. Williams at a conference in honor of the late Fed researcher Thomas Laubach, with whom he produced estimates of R-star, the natural rate of interest given the growth rate of the United States. They suspended it during the pandemic because the data wasn't reliable. He's bringing it back now, and he says the main longer-term consequences from the pandemic period is a reduction in potential outfit. But the imprint on R-star appears to be relatively modest. Importantly, there's no evidence that the era of very low natural rates of interest has ended. So he's suggesting the U.S. is going to grow more slowly, and interest rates will go back to being low like they were. At least according to him, he has produced some new data now. This is quarterly data, and it shows basically no change in roughly where R-star is, although they're estimating going forward into 2023 that it will fall to about 0.5%, which is sort of where we were right before the pandemic. Mickey Bowman, the governor who supervises banks mostly, out today speaking to the Texas Bankers Association and suggesting that perhaps the Fed should have an outside counsel take a look at what went wrong with SVB and Signature Banks. One of the most effective steps they could take would be to encourage an independent third party to analyze the events surrounding the failure of the banks so we can fully understand what led to the failures. She does seem to be pushing back against Vice Chairman Michael Barr's efforts to increase regulation, saying the banks that recently failed were unique in their operations and business models. Those failures alone do not justify layering on an inefficient and overly complex supervision on a broad range of other banks. So news for people who follow banks, news for people who follow interest rates, but nothing about what the Fed's going to do on June 14th.
Next up, the Fed chair, a couple of hours away. Before we get to June 14th, AMH, we need to get through that X date, and let's hope we don't go through it. And Marie, I understand based on recent reporting that maybe that X date and that early June number that the Treasury Secretary Janet Yellen gave us might actually be quite real.
Well, that's what the Treasury Secretary said, as soon as June 1st. And you're not lying when you say it might be real. And the momentum you're hearing, Jonathan, from the White House, from Congress, and the Republicans is that it is moving in a positive direction, and potentially that impetus is coming from the fact that they are concerned that June 1st is really a live date, or the first week of June is really a live date. They don't have a lot of wiggle room to raise the debt ceiling and hammer out a spending cut deal. What you're hearing here at the G7 on the sidelines of this gathering the president is taking part alongside global leaders is that he's also having to, schedule some time as well to keep in touch with his team in Washington, D.C. So it started early this morning, had roughly a 20-minute call with his negotiating team in Washington. He wants to keep that momentum. Speaker McCarthy saying potentially there could be a deal in principle by the weekend. The president would love to see that when he returns home to Washington after he cut his trip short, ending it here in Japan instead of going on to Papua New Guinea and Australia. And then he left a G7 dinner with world leaders early to make sure he can have another phone call with Washington as they begin their day today, and is going to be another day of negotiations between the White House and Republican leadership.
Anne-Marie, thank you. AMH in Japan, Mike McKee here in New York City. Here's the calendar. June 2nd, payrolls. June 13th, CPI. Somewhere in between, who knows where. The X ceiling, X date, whatever you want to call it. Let's get to John Hancock's Emily Rowland, Joe Pawlowski at TPW. Emily, let's talk about it. Just how wide open is the door to another hike next month?
Yeah, the odds of a rate hike in June have gone from 15% to 39% just over the course of a week. And we've seen market sentiment really driving that higher. It's almost as investors are sort of baiting the Fed, saying that if you're going to pause here, we're just going to keep running. And it's working exactly in the opposite way in which Powell and the rest of the Federal Reserve had hoped here. So I think it's certainly open in terms of June. We're going to get a lot of data between now and then, but we'll have to see here.
Never mind the cuts, Jay. Is the data questioning a pause next month?
No, I don't think so, John. I mean, I believe the Fed is on hold. I believe they're done. The inflation numbers for the next few months are going to come in very benign. Remember back in May last year, inflation was 0.9. In June last year, it was 1.2. We're probably going to be close to 3.5 to 4% at the end of June here in the U.S. So I think more importantly than the pause, John, is that the Fed updates its economic forecast. It's going to raise the GDP estimate, which is going to validate the soft landing, validate the higher earnings estimates and positive corporate forward guidance that we've seen coming out of Q1. And I think that's what the markets are sensing. We're over 4,200, which, as we know, is a very important technical level. I think that's going to draw in money. If we get a debt ceiling deal, which we will, the last thing we want to do is show China and the rest of the world that we're not able to handle our finances. So I think we're up and out, John, as you know, I've been saying now for several months.
Well, Jay, you mentioned a growth story. The Atlanta Fed GDP now forecasts something close to 3%. Who knows what those upgrades might look like if we do indeed get upgrades from the Fed at the June meeting. Jay, standout headline for me in the notes I received from you and the team. Jay Pelosi shifting money into tech-related growth. Jay, what's happening there?
Yeah, it is a big change for us, John. And it's basically because I believe AI is for real. It benefits the big tech companies. The big tech got derated last year. Worries over high interest rates. That was our big thrust. We were deeply underweight tech all through 22 and up to very recently. So we're not early on this call, but in essence, big tech is your best play on AI, which is kicking off a new innovation cycle for technology. It has a wide moat because of how much money is needed to play it. Big tech is no longer exposed to interest rate hikes because the hikes are done. And so they're also a very good hedge against recession. So we have now moved from our prior position, at least in the U.S., we still favor non-U.S. over U.S., but that's another story.
Yeah.
We have a barbell now between big tech growth and cyclicals in the U.S. because we do think we're about to see a little bit of a rotation. As the Fed does what we just talked about, we're going to see a rotation back into the cyclicals as new money comes into the market. So your real play right now today is buying the cyclicals in anticipation of the Fed moves that we just talked about.
Well, let's unpack some of that. I'll save the rest of the world stuff for later in the program. Let's focus on the tech call. Emily, looking at these moves, biggest gainers year to date on the S&P 500, NVIDIA at 116%, Meta at 105%. Are they stories you want to chase?
Yeah, John, I mean, AI is clearly important. It's going to be a massive driver of productivity going forward, but it's not necessarily something new. But the market's love affair with AI is something new, and it does create bubble-like conditions in some of these names to us. So we want to diversify beyond that. As you know, we love quality, we love technology, but we're also pairing that with some areas that are going to help us protect against valuation risk. Those areas have run a lot. So we're looking at places like U.S. mid-cap equities to do that. We want to make sure that we're kind of combing underneath the market to find some pockets of discount to marry with that mega-cap high-quality allocation that we have in the portfolio.
Michael Hart of Bank of America this morning, picking up on the moment, said, would be so on brand for stocks to melt up into recession, suck them all right in before the hard landing. Jay, how would you push back against that?
I tell Mike he should look at his own research, which shows that equities have had significant cash outflows for the last 5 weeks. Sentiment is absolutely horrible. People are not participating. So the idea that you have a melt-up, which is possible because money comes in finally, but to go into a recession, look, I mean, the housing is bottomed. Auto production is booming. The inventory destocking, which damaged growth over the last year, is now shifting to a restocking, which is going to help the ISM PMI manufacturing data to break back above 50. So consumer is fine, record low unemployment, housing is bottomed. I mean, I don't see a recession. At some point, people are going to have to give up on the recession, and I think that's when the Fed validates that give up by raising its growth estimates. The Fed is going to be the cover for the recessionistas to finally throw in the towel.
Well, when they throw in the towel, that's probably the moment we get one, Jay. You know how it works. Jay Pelosi, Emily Rowland, the two of you are going to stick with us. Here's a mover for you going into the opening bout, 20 minutes away. The team on Bloomberg Surveillance did a wonderful job of breaking this news. Morgan Stanley, just a touch lower. James Gorman, the CEO, stepping down. At the annual shareholder meeting, here's the quote. It is the board to my expectation that it will occur at some point in the next 12 months. That is the current expectation in the absence of a major change in the external environment. Shonali Basak has more. Hey, Shonali.
John, what a moment it is on Wall Street. This is one of the longest-serving CEOs of this era. He's been in charge for more than a decade. He's about to turn 65. That is about the age that we're seeing a lot of CEOs start to turn the page. You are seeing the stock react more immediately, slightly down. But remember, James Gorman is such a fixture at Morgan Stanley. He has made such a massive strategic change for this bank. Few really believed how well it would work out at the end. If you take a look at Morgan Stanley's stock price performance since he took over in January of 2010, you can see it outperforming relative to most of its rivals, certainly relative to Goldman Sachs, only really trailing behind JP Morgan in that time frame. And when you look at its price to book value, it really does compete very, very strongly here with JP Morgan. Now, these strategic changes leave a big question. Who will take over next? This, John, is classic Morgan Stanley. They tell you something will happen in 12 months, they wait a couple months, and then they tell you who has the top jobs. Right now, for two co-presidents, Ted Pick, Andy Saperstein, who is more closely aligned to the wealth business, whereas Ted is more closely aligned to institutional securities. Those are the two men to watch. You could also watch Dan Simkowitz, who runs investment management, and the race is on, especially when you know how much Morgan Stanley has pivoted to wealth management. Ted had previously been seen as the top contender here, but a big question mark open now on Wall Street on who takes over next.
Shonali, we've seen this game play out a few times. Do you remember Goldman, blank fight standing down? It was Schwartz versus Solomon, and we were watching that race for a while. Is it a repeat of that?
It's a healthy competition, isn't it? And the thing about Morgan Stanley, it's pretty excruciating because you've seen this go on for a very long time. You've seen many generations of presidents at Morgan Stanley wait for that top job. And now the time has come. Andy, in particular, is very interesting, has been a lieutenant to James Gorman for a very, very long time, whereas Ted Pick had grown up under Colm Keller, the previous president who we now know is the chair of UBS. And so very loyal talent under both of these people, and that is what makes this race on Wall Street just so interesting.
What a company he's built. What a run, just phenomenal. James Gorman stepping down. We'll pick up on that story again around the opening bell. That stock is just a touch lower in early trading in the pre-market, down by 0.6%. Plenty of big moves out there. Let's get a few of them for you. Here's Abby.
Indeed, John. And turning to regional banks, let's take a look at the shares of PacWest because they are popping higher for a third day. In fact, up more than 25% if the current gains hold to the close over the last 3 days. And this was set off by Western Alliance's positive bank deposit growth a few days ago. Deere also higher, up 3.4%. They put up a monster quarter, an 8% revenue beat on almost $16.1 billion, $10.11 per share in adjusted earnings. That's an 18% beat on big demand for farm equipment. To the downside, though, raw stores down almost 1%. Guidance is seen as light for the retailer. And then finally, Applied Materials, the cap equipment maker, down 1.53%. Their guidance upcoming, it's on the low end memory chip, that slump weighs that stock down 1.5%, John.
Abby, thank you. Coming up on this program, cracks emerging in one of this year's big consensus trades.
Most client meetings, not recently, but about 2 weeks ago, it was, we agree. We think euro goes higher. We think the pound goes higher. We think the yen goes higher. That's now changed quite substantially.
Some big changes out there. That conversation up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The data in Europe has really underwhelmed. I thought at first we could ignore it. I thought the factory orders falling lower, that's something that maybe could be corrected in the next month. But what we've actually started to see is the more forward-looking signals, such as the ZEWs, those sort of sentence index in Europe, they've also been turning lower as well. So the momentum's gone. Most client meetings, not recently, but about 2 weeks ago, it was, we agree. We think euro goes higher. We think the pound goes higher. We think the yen goes higher. That's now changed quite substantially with these data surprises and market moves. And I think it's a lot more uncertain out there.
Big changes out there. Bank of America's Michael Hartner picking up on the zeitgeist at the moment. AI just making babies of the bears. Consensus was bullish China, bearish US. It will be the mirror opposite by Independence Day. JP Morgan's Mislav Matejka picking up on that theme, saying this: the activity upswing seen around the turn of the year, helped by the falling gas prices in Europe, by China's reopening, is unlikely to transition into an acceleration in the second half. Nomura's Jordan Rochester following up. European and Chinese data surprises are in free fall, pushing the Eurozone data surprises to big lows. It points to weaker growth expectations and with it, a stronger US dollar in the near term. Are these just cracks, or is one big consensus trade unraveling? Emily Rowland, Joe Poloski, back with us. Emily, weigh in on this one. Are we pushing back against that rest of the world story?
Yeah, John, I'm going to say something not a lot of strategists say on your show. We've been wrong about the call in Europe. You know, it's been unbelievable to watch the resilience of European markets over really starting in the third quarter of last year based on China reopening, based on better weather in Europe. But our view has been that you want to allocate assets to higher quality markets. You want to underweight more cyclical areas of the world that should be more impacted as global economic growth slows. And we did start this week with some pretty disappointing data out of China, out of Europe. Industrial production, Eurozone GDP came in at just about 0%. And meanwhile, these markets continue to surge. There's a FOMO element here. There's a sentiment, momentum element that's been driving these markets higher. And I don't know what the catalyst is. You know, you look at Japan reaching new highs. You look at European equities at 52-week highs. I don't know if it was better news around the debt ceiling, which doesn't make a ton of sense to us, or something else. But there's been a lot of resiliency there. We would trim those areas of the market. We would redeploy to the U.S., more higher quality, more defensive assets as we wait out this late cycle environment.
The DAX right now, record high. Luxury names year to date, they've been absolutely flying. Jay, I know you're going to push back against the view that maybe we should retrench here.
Yes, John, I will fill my role here, buddy. You know, we've been quite bullish on Europe for well over a year. As you know, we've talked about it forever. At the end of last year, beginning of this year, on this show, I talked about switching our focus to Asia, and particularly Japan. And we're just very bullish on Japan. Japan, you know, the S&P is at a year-to-date high. Japan is at a 33-year high. And the reason for that is because finally they're exiting structural deflation. And you have the highest wage gains in the last 30 years in Japan. And so what this means is that Japan is the fastest growing of the G7 economies. And so you have earnings growth, you have very cheap valuation. Half of the Japanese stock market, John, trades under book value. And there are governance changes taking place to force companies to trade above book value. So you're seeing massive share buybacks, you're seeing mergers and acquisitions. The PE companies are all over Japan. And we think there's more to come in the sense that we expect the end of yield curve control to happen in the next couple of quarters. That's going to lead, we believe, to a massive asset allocation shift among domestic investors who have been buying nothing but bonds for the last several years to start buying stocks. So the chart looks beautiful. The market is still cheap. Yes, it's a little extended, but I think Japan is going to significantly outperform the U.S. over the second half of this year.
Well, Jay, that's a very specific call on one particular country. For the rest of the world, Emily, which we've been talking about, China's been the main theme for so many people. Is the data validating a cyclical story? Is copper validating a cyclical story? Is there anything out there validating it right now for you?
Yeah, not for us. And by the way, I do love a beautiful chart, so I hate to argue with you, Jay, here, but we're not really seeing the catalyst for this shift to more cyclical areas of the market. Look at PMI data, well below 50 for the rest of the world, just above 50 on the manufacturing side here in the U.S. So we would be fading that. Again, sentiment, FOMO, critical drivers here, but there's only so long that we think sentiment can move these markets forward. We look to the U.S. again as having that higher quality element to it. That's where we want to be in a late cycle environment. Look, this is a tricky period. In a late cycle environment, it doesn't mean you want to dump equities. You still want to have some exposure to stocks. Things can run. We're clearly seeing this as of late. We would want to be really thoughtful about, again, underweighting areas that are going to be more sensitive to the global economy.
We all love a beautiful chart. Emily Rowland, Jay Pilowski, we're out of time. That was great. I knew we'd have a good time. I appreciate it. Have a good weekend, guys. Going into the opening bell, 7 minutes away. Coming up, the morning calls, and later, we'll speak to Morgan Stanley's Jim Karen on why the Fed's preparing for a pause and not a rate hike in June. That conversation coming up shortly. We will not discuss with him why his boss is on his way out the door. James Gorman stepping down at Morgan Stanley. That's the latest news this morning. The stock is negative by 0.6%.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Let's get the mic on. There we go. 4 minutes away from the opening bell. Equities up by about 0.3% on the S&P. Let's get you some morning calls. First up, Macquarie downgrading Disney to neutral, warning that numerous uncertainties could start weighing on investor sentiment. Argus upgrading Wendy's to buy, expecting the company to benefit from international expansion and investments in its digital business. And finally, Citigroup upgrading the Gap to neutral, $8 price target, seeing a more balanced risk reward, with shares hovering at 3-year lows. Their stock is up by about 1.5%. Coming up, another retailer sounding the alarm on a softer consumer, plus Morgan Stanley's Jim Karen on why it's better to be balanced rather than defensive in today's market environment. And we'll catch up with Sonali Basak on the latest from Morgan Stanley and James Gorman stepping down.
think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Is the bumpy road to nowhere starting to go somewhere? Two-day pop on the S&P 500, biggest two-day move going back to about April on the S&P 500 right now. New highs for the year. Equity futures positive 0.2% on S&P 500. Futures on the Nasdaq just about positive on the Nasdaq. There's the opening bell. Switch to the board and get to the bond market. Yields high on Monday, Tuesday, Wednesday, Thursday. Again this morning at the front end of the curve on a 10-year. At the longer end of the curve, higher by 4 or 5 basis points. Just south of 370, 369 there on a 2-year in America. Yields higher there, 6 basis points. We started this week opening up on a 2-year below 4%, right now above 430. Seen some dollar strength around that story. Euro dollar a break of 108 yesterday, just above it earlier, now just around that level, 107.97, positive 0.2%, and crude just about positive here, up by 8 or 9 tenths of 1%, $72 and about 50 cents. About 30 seconds into the session, positive 0.2% on the S&P 500. The number one stock to watch at the opening bell, Morgan Stanley. Here's the news. James Gorman announcing plans to step down as CEO within the next 12 months, telling shareholders at their annual meeting the following. It's the board's and my expectation that it will occur at some point in the next 12 months. That is the current expectation in the absence of a major change in the external environment. Shanali has more. Hey, Shanali.
Hey, John, if you take a look at it, of course, you have Morgan Stanley shareholders. Initial reaction being the stock down. You have to remember that James Gorman at Morgan Stanley was a huge reason that the stock has become one of the best performers in the market since he took over, only behind JP Morgan, and the rise of about 185% in the market since then compares with 95% over at Goldman Sachs in that same time frame. We've been talking about it a lot, the strategic shifts that he has made. The former McKinsey executive here had really made these tough choices over at Morgan Stanley that paid off in the longer term. Now, if you think about the next generation here, that is the big open question. There are really 3 people to watch here. We've been talking about Andy Saperstein, who has really reshaped the wealth business. We have talked about Ted Pick, who has been the leader of the institutional business, grew up in that business, went through some very tough changes in that business over the last even 5 years alone, but also Dan Simkowitz. We should talk about him as well because he runs that asset manager, which just 5 or 6 years ago, you couldn't even imagine surpassing $1 trillion. And here we are, Morgan Stanley competing, previously the little sister of the industry, and now competing with the giants.
It's turned around in a massive way with his leadership. Shanali, we talked about Goldman and the race to take over from Blankfein back in the day, Harvey Schwartz, David Solomon. Let's talk about this race and maybe offering a template for what might happen or might not happen at JP Morgan. Just this elegant move away from the CEO role, just to sit there as the chairman. Is that a template for elsewhere, do you think?
I think it is a template because the new generations over at JP Morgan, for example, they are quite homegrown, but there are a lot of questions about what such a big bank would look like without Jamie there. So it is an interesting solution to have them in the sidelines. Remember, the age is also different here. James Gorman is turning also very elegant 65 years old this year. That is the age now that is seen as the kind age to start turning the page, as Jamie Dimon has been at the helm longer. He has done more acquisitions over a long period of time. He is really so rooted in this firm. He's 67. And so there are real questions here about when he is also going to turn the page and whether his deputies are ready.
5 years. It's usually just 5 more years, right?
5 more years.
Not 12 months. But
One day,
when he says 12 months, then it gets serious. Shanali, wonderful coverage. Looking forward to your coverage through this morning. Morgan Stanley negative by about 1% in the early part of the session. Let's turn to earnings quickly. Deere raising its full-year profit forecast amid strengthening demand and easing supply chain woes. The CEO saying this: we continue to benefit from favorable market conditions and an improving operating environment. Abby has more. Hey, Abby.
Hey, John. Well, it's interesting because peak ag, the fears that peak ag, we may be seeing it. It's not hitting Deere's results, at least not in this quarter. A big quarter, they beat earnings in a big way. Adjusted earnings were 18% beat, $10.11, an 8% revenue beat, almost $16.1 billion. So big numbers. Growing. They raised the outlook, to your point. Interestingly, this stock is down on the year, but now thanks to today's pop, the best day since early February, the shares of Deere are down less than 10%. So it seems as though they are turning a quarter, but more is needed because some analysts are still concerned that peak ag could drag. But at least right now, Deere managing that very well.
Stock up more than 3%. Abby, thanks for that. Let's take a look at Disney. The company announcing plans to begin removing programs from its streaming service. Just the latest step in its efforts to reduce losses and cut costs. The stock's down by 1%. Katie Lyons, there is so much news around this company in the last 24 hours. I don't know where to start.
Yeah, well, if we start there with the streaming service, these are shows that they already had decided not to renew, but now they are removing them from the service entirely to avoid the additional costs like paying residual fees to the participants in the shows. Again, trying to return this business or bring it really to profitability. The other news, though, comes down in Florida, where Disney has canceled plans to relocate 2,000 employees from California to the Sunshine State with an $864 million campus they were planning to build, no longer being built. They're also going to shutter their Star Wars hotel that cost, mind you, $4,800 minimum for 2 nights. This is amid the ongoing fight Disney has with Florida Governor Ron DeSantis. They didn't mention that directly in these announcements, just cited changing business conditions. So maybe read between the lines there, John. But the governor's office did put out a statement saying this move wasn't surprising, given the company's financial straits, falling market cap, and declining stock price. And again, John, the stock price is declining this morning, down a little more than 1% here at the open.
92.65. Katie, thanks for that. That's the wrap with Disney. Where to start, where to end. Disney getting a downgrade. Shares of Disney downgraded to neutral over at Macquarie. The team over there writing the following: linear networks are getting worse fast. Ad revenues will likely remain negative in the fiscal third quarter, and affiliate revenue may remain negative for good as cord cutting gathers speed. We see the stock as range bound for now. That stock, as Katie indicated, is down about 1% this morning. What a shift to retail. Shares of Foot Locker getting absolutely hammered after cutting their annual sales forecast. The CEO saying the company's revenue has, quote, softened meaningfully given the tough macroeconomic backdrop. Isabel Lee has more. Hey, Isabel.
Hi, John. Tough indeed. If you need more evidence that Americans are pulling back on their spending, look no further than to Foot Locker. The company cut its annual sales forecast, saying revenue will fall by as much as 8% this year. That's down from the initial 5.5% that they projected. Profit forecast is also down, now seeing adjusted earnings of as much as $2.25. That's lower than the previous high end of the 365 revenue. Shares are tanking indeed. It's now down by around 25%. Year to date, Foot Locker is also down by 16%. But John, this is a broader story because Foot Locker isn't the only one warning about this. We have Home Depot, Target, Walmart. The U.S. is really seeing a big demand problem, John.
A quarter of the value of that company gone, just like that, in 6 minutes of trading. Isabel, thanks for that. The broader market right now, through 4,200 on the S&P 500. Just positive by 0.24% on the S&P. Looking ahead to Chairman Powell a little bit later on this morning. It was nearly 9 months ago, on August 26th, 2022, that Chairman Powell said this.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
That was Jackson Hole 9 months ago. So what happened next? The unemployment rate that summer, 3.5%. The unemployment rate now, 3.4%. As for the market, the morning that Powell delivered that speech, the stock market opened up at 41.98. Yesterday, the stock market closed at, guess what? 41.98. Joining us now to discuss, Morgan Stanley's Jim Caron. Jim Caron, what pain?
That's a good question. Well, there was some pain along the way, and that's absolutely for sure. But I think all the focus right now is on thinking about what the Fed's next move is going to be, and I think that they're going to stay on hold. So, look, I mean, the market is not the economy. The market is doing reasonably well. There's no question about that. But when you look at the economic data, it's holding up better than many people had thought. And you had mentioned earlier on the show that the Atlanta Fed now GDP now is even close to 3% for the second quarter. So all of that is really, really good. But we do have to recognize that the run rate of growth for this entire year is probably closer to 1 to 2%. We may get some slowing in the economy in the second half of the year. That certainly may be the case. But it's certainly not the disaster scenario that many people have been forecasting. So, look, the economy is slowing. We've hiked rates 500 basis points after all. It's supposed to slow. So the next move by the Fed, I think, is really just to stay on hold. The next move is no move.
What would you expect to hear from Fed Chair Jay Powell later this morning, Jim?
I think more of the same. I think that they're going to talk about this in not so many words, a higher for longer, getting to sufficiently tight policy levels. And sufficiently tight, that's going to be the code word, meaning that sufficiently tight means that they can hold those levels there for an extended period of time. And I think that's going to be the statement that I'm looking for. If he says something along the lines of, potentially financial conditions need to tighten more or something like that, then I think the Fed's back in play. But I think sufficiently tight monetary policy levels is essentially going to be his message.
We need to get a market call. Tony Dwyer of Canaccord Genuity, good friend of this program over the last week or so, said to us he was too nervous to get short, too anxious to get long. You say this, Jim, it's a moment to be balanced. Can you tell us what the difference is between balanced and defensive? Because I hear defensive a lot. What does balance mean?
So balanced means balanced is an asset allocation decision, meaning that you're balancing the risks both upside and downside. And John, you and I have spoken about this all year. One of the things I've said is that risk on is a risk like any other risk, and it needs to be hedged. And what defensive is a style. So defensive positioning is when you expect an economic outcome and you position for it. And what we decided to do at the start of the year was really have more of a balanced look and basically say, look, there could be some downside, there could be some upside. Let's position a portfolio so it's durable if either scenario occurs. A defensive style portfolio is going to be one that's going to be more rooted in fixed income and more defensive equity related sectors and what have you. So that's not the kind of environment that we're in right now. I think that the risks in the economy today and in the market is more balanced upside and downside than what the consensus bearish narrative would suggest. So I think a balanced portfolio that really allows you to play for both either the upside or the downside, so it's a good asset allocation strategy, well-diversified portfolio, is better than selecting what you believe will be a defensive outcome or a negative outcome and positioning defensively because of it. And that's why we think it's better to be balanced than defensive.
So Jim, can you walk us through how you would be balanced? And can we just start with positioning for upside? How would you capture that upside? What pockets of the market are you sitting in for that?
Yeah, well, first of all, the equity market. I mean, essentially, what is a balanced portfolio right now? Is it 60-40? Is it 50-50? What is the case? What we've seen is that there's been an underweight to equity risk. People have favored cash and they favored fixed income, and you can see that from building cash levels. One of the things that we've put into our portfolios is a more aggressive, higher allocation to equity. Now, our allocation to equity right now is roughly about 50 to 55% relative to fixed income. That's not extraordinarily bullish. That's relatively balanced at this point. But when we compare that to the narrative in the market and the positioning that we see in the market, if you look at long-short ratios and things like that, the markets are pretty much underweight equity risk. So all we're saying is get back to more of a neutral equity component. And John, look, one more thing. When we look at the equity market, it's 25% up in tech, it's 3% up in consumer discretionary, and 3% up in industrials. Everything else is flat to down. So this is not a wide breadth market. If we do get some reasonable economic data and growth, the rest of the broad market could actually start to do better. And it's coming from a negative on the year. So there are some positive possibilities that I think that we need to hedge for. We could disappoint to the upside, is the way I like to say it.
Jim, that's the equity side of the story. Can we throw in credit as well? Credit just seems to be stuck somewhere in the middle right now. How are you playing that?
So our view is that we're not going to have a hard landing. So as a result of that, we see default risk as being relatively low. But we also think that the interest rate markets, the government bond market, has priced in, and well, at least a couple of weeks ago anyways, or even the start of this week, had priced in a lot of rate cuts. So one of the things that we're doing is we're allocating more towards high yield and more towards credit to collect the coupon, the all-in yield, but we're reducing the interest rate sensitivity of the portfolio. So that means that we're trying to step away from U.S. Treasuries, and we're trying to add more towards high yield and towards investment grade credit, and even non-agency mortgages. These are areas that we think are going to do reasonably well in a non-hard landing scenario, and that's our base case.
Hey Jim, love it. Great to catch up. Jim Karen there of Morgan Stanley talking about disappointing to the upside. Disappointing if you're not positioned for it. 3-day gain on the S&P 500. About 13 or 14 minutes into the session, the S&P is up by 0.3%, advancing once again. Michael Hartnett of Bank of America, great note again this morning from Michael and the team over at B of A. It would be so on brand for stocks to melt up into recession, suck them all right in before the hard landing. This is we reprice the yield curve higher, particularly at the front end of the curve over the last few days. Every single day this week, this 2 years been higher. Started the week just south of 4%, right now north of 430, 433, call it 434 on a 2-year, up by 8 basis points. Euro move starting to fade again, 107.93, just seeing a touch of euro strength after a few days of dollar strength on the other side of the trade. And if you are just tuning in, the latest news this morning, James Gorman planning to step down from Morgan Stanley, announcing at the firm's annual meeting, it is the board's and my expectation that it will occur at some point in the next 12 months. That is the current expectation in the absence of a major change in the external environment. That stock is, at the moment, Morgan Stanley, slightly negative this morning. Coming up on this program, plans taking shape for a debt limit vote on Capitol Hill.
The negotiations are currently making progress. As Speaker McCarthy has said, he expects the House will vote next week if an agreement is reached, and the Senate would begin consideration after that.
That conversation up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling, because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like, just the joy that you had brought to the city was phenomenal.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The negotiations are currently making progress. As Speaker McCarthy has said, he expects the House will vote next week if an agreement is reached, and the Senate would begin consideration after that. Members should remain aware and be able to return to the Senate within a 24-hour period to fulfill our responsibilities to avoid default.
Everybody playing nice for now. According to a White House official, Biden telling his hand-picked negotiating team in Washington that he's confident Congress will act in time. Speaker McCarthy also sounding confident.
I see the path that we could come to an agreement. And I think we have a structure now, and everybody's working hard. And I mean, we're working 2 or 3 times a day, then going back, getting more numbers.
The mood music sounds okay. The numbers do not. The Treasury's cash balance dropping to $68.3 billion, according to the latest data. That's down from $94.6 billion a day earlier, down from $140 billion at the end of last week. With Axios reporting at the moment, the Secretary Yellen is warning both publicly and privately that the early June X date is real. Kaylee Lyons joins us now from D.C. for the latest. Hey, Kaylee.
Hey, John. Well, I spoke with a former Treasury spokesperson on balance of power earlier this week, who also said we should take that seriously. No joke, no smoke. If she says as early as June 1st, that date is real, especially as you alluded to. We do have the Treasury's cash balance now at the lowest level since 2021. So that just speaks to how tight the timeline realistically is here. Even if we do buy the fact that progress in the talks is happening, all of this optimism is actually real, that compromise still needs to be turned into actual legislative text, put on the floor of the House, voted on, passed on the Senate, voted on, passed, and then ultimately get to the president's desk. That is a lot that has to happen in a less than 2-week period in theory, and it does become a question of the vote count as well, because we understand that work requirements for entitlements has become a real sticking point. That is not something that progressives in the House would like to vote for. It's a big issue with the Congressional Black Caucus as well. Then in the Senate, you had a group of senators, including the likes of Senator Bernie Sanders, writing a letter to the president yesterday saying that he shouldn't be giving things up. Instead, he should evoke the 14th Amendment. At the same time, the House Freedom Caucus also put out a statement yesterday saying no further negotiation should happen until the Senate passes the bill the House passed. So what it feels like, John, is that at the sides of the parties, they seem to be moving away from the idea of compromise at the very same time that those in the middle, those negotiating, are trying to move toward it.
Kaylee, you said it. You went through the process there. That piece of it, voted on, passed. Is that the piece of it that a lot of people in Washington are nervous about at the moment?
Yeah, that's really what it comes down to now, John, is the vote count. Because if we are starting to see the contours of a deal forming, what really contains in it and whether or not it is passable is going to be key. Because remember, Speaker McCarthy made a lot of promises to certain members of his caucus just to get the initial bill he passed through. Many in the Republican Party likely would not want to vote for a package that saw a lot of that taken away. So you're going to need some Democratic votes. But again, there are Democrats who have serious issues with some of what measures could be on the table here. So the math could get very tricky on both the Republican and Democratic side, John.
Kelly, thanks. That's the roundup down in Washington. I mentioned that story from Axios. Here's the lead paragraph from it. Treasury Secretary Janet Yellen warning the country's biggest bankers that a potential debt ceiling default will have repercussions beyond the financial system and insisted, this is the key part, that the early June ex-date is real. That's their latest reporting this morning. The latest price action this morning, 22 minutes into the session, we are just about positive on the S&P for a third session, up by 0.3% with a sector price action. Here's Abby.
And being higher for a third session, John, means at least this week that the S&P 500 is up more than 2% on the week, the best week going back to March. As for sectors today, energy leading the way, up 1.3% with oil higher. Healthcare is also up 1%. Only two sectors are down, technology and discretionary. And in the middle, we have financials. They are up about 0.3%, despite the fact that on the day, Morgan Stanley is down. Last time I looked, down by about 1% on this news that Morgan Stanley's CEO, James Gorman, is to step down within 12 months. On the week, though, Morgan Stanley is higher. That's true, too, for the financial sector, with lots happening also for the regional banks, up about 3% there for the financials. Taking a look at some of the other sectors, we have lots of the big tech sectors higher, communication services. We also have the tech sector itself higher, consumer discretionary. So those are the three mega cap tech sectors, and there's those financials again. Net, John, a bullish week.
Abby, thank you. A better week on many fronts as we inch towards the weekend. Before we get to the weekend, a few more things to get through. Your trading diary up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Three-day winning streak on the S&P 500. We'll see if this sticks. Longest winning streak on the S&P going back to early April. That's the price action right now. Let's get to the trading diary. It looks like this. Fed Chair Jay Powell speaks at 11 Eastern time. Then looking ahead to next week, JP Morgan's Investor Day coming up on Monday, plus more Fed speak from Bullard, Bostic and Barkin. Looking further into next week, another round of new home sales. And then Wednesday, we get the FOMC minutes as well. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day and have a wonderful weekend if you can. From New York, this was the countdown to the open. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but, you know, we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rate while
This is a 3.
As the economic picture does.
The BOK is getting ready to make.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in five stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines, because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines.
Connection lost.
To my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that.
at a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp